लाइव कर रहे हैं तो प्लीज स्टार्ट।
Okay. Good morning, students. Happy CA Day to all of you. It is my great pleasure to welcome you to this, one more session or one more edition of live virtual classes. Those of us who attended the classes here for the July, you must recall that we had classes start in the month of April. We went on till the month of May. We had so many motivational lectures, and thousands of students attended these classes. And we felt that, you see, with the kind of response that we got from the students, and with the total encouragement from the president and the vice president, who are here with us today. And you see, I acknowledge the presence of both the president and vice president, because both of them, they have encouraged us to go for these virtual classes. And so now, from today, on this auspicious day of the Chartered Accountants Day, we are now starting off the virtual live classes for foundation, intermediate, and final for the November 2020 examination. Please note, you see, in the earlier times when you had gone for the revisionary classes, you had gone for the mock test papers. You see, I'm sure the similar situation will happen here. Even here, we'll have the mock test papers, and here in these classes for the foundation, we'll have classes from 11 to 1 p.m. and 2 p.m. to 4 p.m. The intermediate is from 7 a.m. to 9:30 a.m. and 6 p.m. to 8:30 p.m. Final from 7 a.m. to 10 a.m. and 6 p.m. to 9 p.m. Now, if you see, and we will carry on till the month of October. Now, if you see, it's July, August, September, October, 4 months of intensive classes. And what we propose to do is cover the syllabus for both the groups and make you fit and ready to face the November 2020 exam. So it is very important that you attend these classes. Please note, we are also having the recorded features. So by chance, if you miss the classes, you can always go for the recorded lectures. And we have this system of interaction. That is, you may use the chat facilities that is there in the classes. And you see, you can chat with the teachers, ask them questions. And when I speak of the teachers, we have got some of the best teachers who are going to teach you throughout these 4 months. And you see, most important is your feedback. If you go on providing us with feedback, then we can make innovations to suit your requirements. Because at the end of the day, what is in our heart is your well-being. That you study, that you enjoy the course. So see, with these words, I welcome all of you to this live virtual classes. The Board of Studies takes great pride in presenting these live virtual classes to you. And please note once more, because of the initiative of the President and the Vice President and the Council, these live virtual classes are free of cost. So that is very, very important. It is totally free of cost. So once more, welcome you. And before I request the Vice President to speak, I was writing my chairman's page for this July issue of the Chartered Accountants the Students Newsletter. And there I had quoted Pele. And Pele, most of us, we must have heard of Pele. Even if you don't play football, you must have heard about Pele. And what does Pele say? Pele is saying, success is no accident. It is the result of hard work, perseverance, learning, studying, sacrifice, and most of all, love of whatever you are doing. So have passion for the course, have love for the course, and I have no doubt that success will be at your doorstep. All the very best. With these words, may I now request the Honorable Vice President of the Institute, Nihat Jambusaria, to kindly address all of you.
Honorable President of the Institute, C.A. Atulji, the Chairman of Board of Studies, C.A. Debashish Mitra ji, Vice Chairman, C.A. Sushil Goyal ji, Good morning, friends, and wish you all a very happy CA day. In a way, you may say that we have not so far qualified as CA, but I'm sure that all those who enter this course ultimately qualify as CA, and you should have spirit of a chartered accountant when you join this course and that kind of patience. So I wish you also a very happy CA day. Friends, I was looking at the efforts of the Board of Studies and I was amazed the manner in which day and night the Board of Studies works under the leadership of chairman and vice chairman. I saw the reforms in study material. They are trying to make these study materials the best in the world. Some of the students in the past pointed out that we need more material for practice, and they immediately swung into action and incorporated a number of questions for you to practice. Application based material is added, and case studies under the insistence and strong insistence of our president that we must not stick to theoretical work and let us give case studies to the students, because even our examination system we are shifting to case study based, which gives practical approach to the students. Under his leadership, both chairman and vice chairman along with the director board of studies took this mammoth task, and you would be seeing totally how many case studies are available to you. And with these case studies, I would wonder whether anybody can fail in CA exam. Probably the task of the examiner will be so difficult, you will be so trained that you will have full confidence before you appear for the exam. Now e-books are available, e-capsules are available, and I would have loved to be student of CA once again under such dynamic chairman and vice chairman, but for the fear of failing, because we appeared long back and now times have changed. The centralized distribution system of material, where particularly you are given coupons and you can order your material even after a time lag, so that the material is totally relevant to your attempt. This facility is also offered, and I'm told that the Board of Studies is after CDS to see that the time lag between the time you order and the material is delivered is reduced to just 2 to 3 days. They are after CDS system. Now at present in the pandemic time, it is possible that delivery would take some more time, because the couriers are also facing difficulty of transportation. Coming to these classes particularly, I think it is wonderful that today for the November batch 4 months in advance, the Board of Studies is coming out with exhaustive syllabus coverage through virtual classes for all the three: foundation, intermediate and final. And these classes will go on up to October. I recall my time when I was a student, we did not have classes. And particularly the difficulty that we faced was that we had number of books, number of practice questions, if I talk of accountancy or tax. And when we used to solve question and try to tally it with the answer which was given at the end of the question, many times answer did not tally, and we had to struggle for more than an hour to find out where the mistake is. Whereas now, when your classes will go on up to October end, you will have opportunity to ask your difficulty to the faculty, and who will clear your concept completely. So this facility in our times was not available. This is an excellent facility which BOS is making available to you. This is pandemic time. I understand that a lot of negative thoughts may prevail, but the entire world is facing it. And now over the last 3 months, I think we have become used to it. and it will give a lot of fighting spirit or killing spirit to all of us. So as students take it positively, you will not have such opportunity to face challenges at the early age. And this challenge, if you face successfully, and there is nothing, don't allow negative thoughts to enter your mind. Be focused completely on studies, and now that you will not have disturbance, plus you will have support of the faculties to clear your doubts, I think your only task should be to focus only and only on studies and clear the exam in November and stand with us. Also, let me mention that when by the time you will qualify, this pandemic would have created number of new opportunities. The entire economy has to reboot. The government is making efforts. CA Institute is supporting the government and clients and society. And when you will join, a number of opportunities will be open for you. So please be prepared, be techno savvy, be a very sincere student and clear the exam at the earliest. Number of opportunities are waiting for you, and I wish you all the best for this exam. I'm sure that you will all pass with flying colors. Thank you so much.
Thank you very much, Vice President, sir, for those words of encouragement. And I have no doubt when you talk about the skilling spirit for the students, that you see that passion to succeed. If the students have heard you right, you see, I'm sure they will do very, very well in the examination. You see, if as they go ahead. We have with us C. Atul Gupta, the Honorable President of the Institute of Chartered Accountants of India. And if these virtual classes are there, then the free virtual classes, one of the you see, a person who really backed this whole concept has been the President of the Institute of Chartered Accountants. You see, without his support, we could not have come so far. And see, virtual classes free of the club. So, see, can we just the President of ICAI, Honorable President Atul Gupta ji, to kindly address the students.
Thank you, Devashish Mitraji, the Honorable Chairman, Board of Studies, and the Honorable Vice President ICAI, Nihar Jambusaria ji, Sushil Goyal ji, the Vice Chairman of the Board of Studies, and Madam Vanna Nagpal, the Director Board of Studies, and all the my future chartered accountants. Very good morning to all of you. And at the outset, I congratulate each one of you on this CA Foundation Day. Today, we have completed this journey of glorious journey of 71 years and entering into the 72nd year. So it's a 72nd Foundation Day. And I believe that you will all will agree with me that once you will become the chartered accountant, it will be like a great honor and respect in the society, because you will be the part of this elite profession. And you will also agree with me that the contribution made by the past presidents, council members, and even the complete ICAI ecosystem will be giving you a lot of respect and I will say the grace in the society that you are a chartered accountant. You are being a chartered accountant, you are not respected only in India but also at the global level, because through the mutual recognition agreement and even unilateral recognition, your profession is being recognized at the global level. You will be surprised to know that once you will become the chartered accountant, your qualification through the MRA. So say for example, you want to settle in the UK. So we have the MRA available with the Institute of England and Wales. And without even appearing any paper, you can take the degree of the England and Wales Institute as well. And likewise, if you want to practice in Mauritius or in some African countries or even Malaysia, so you have the license, you have the right to take the license over there. Even with this qualification only, you need not to take any other qualification. So that kind of a recognition, the global recognition, a course which is only the Institute of Chartered Accountants of India, your CA course. Friends, as rightly explained by Vice President, so I will not touch upon the various initiatives taken by the ICAI for the benefit of the students. We started a journey of revamping the entire thing since 2017. even prior to that, even 2015, when we started this journey to create a new set of curriculum for our students, and finally we launched the new curriculum of ICAI in 2017 with the Honorable Prime Minister of our country, Narendra Modi ji, launched the new course. You will be surprised to know as well, and you should feel cherished and blessed that if you will ask me in the last 6 years of the Honorable Prime Minister whether he launched the any course of the any educational body, the answer will be yes, one body only, that is the Institute of Chartered Accountants of India. So that importance you carry in the society and that importance you carry in the economy, and even Honorable Prime Minister recently forwarded us his blessings in a shape of a letter and conveyed that the nation proud of you. So my only humble submission to you that since all the efforts initiated by the ICAI or the Board of Studies, they are working day and night for the benefit of the students, for the welfare of the student, to support you, each one of you. Now, for example, just to share with you this example, that on the 1st of July at 7 a.m., Honorable Vice President, Chairman and Vice Chairman of the Board of Studies and the entire team has pulled their socks to provide you the online education without any charge through the ICAI. So this is a live example that we are fully committed. We have, you practically understand that Devashish Mitra have no interest that, okay, somebody, his relative is learning or somebody else is learning. It's purely and purely passion and the love for each one of you that everybody is working hard to provide you all the services and the facilities, whatever we can do. Friends, it is very important for you as well that I used to say that it is not the aptitude but the attitude that determines our altitude. So yes, I always say that the attitude is very, very important to become a successful chartered accountant, but at the same time, the foundation is the aptitude, meaning thereby your technical skill set. And that is very, very important that we should not be going for a rota learning kind of a situation. We should understand the concept. We should have the case analysis. We have to go in deep into the particular subject. You should be in a position, I just tell you as my personal experience, then when I was preparing, because we were not having that kind of a facilities available, that kind of a, I will say the economically we were not so strong. So we were, even I was teaching when I was studying. So it was a case that when I was in the final, I was appearing in the final paper, I was also teaching the students of the final, just to support them so that they can also prepare themselves. So you should be in a commanding position that you are preparing so well, so deep and so with the analysis that it will be the lifetime learning for all of you. So even if you ask me today after 25 years of my preparation that what is simplex method or a Q theory or any other concept related to the financial management, make or buy or lease or buy, so I can explain you each and every concept even after this 25 years. Why? Because it was not a rota learning, it was a practical understanding of the concept. So it is very, very important that we have to see there is a buzzword called learning outcome approach. What is mean that? Meaning thereby that once you will become a chartered accountant, once you have learned something, what kind of outcome is there? Whether you are becoming employable, whether you are becoming a skilled person and the future ready professional, then you will automatically get your answer. So it is my humble request to all my younger brother and sisters that you please concentrate on your study, concentrate on your skill sets, concentrate on the future ready professional, and see that we are not going for a rota learning that okay, somebody is giving you that okay, you have to only answer this. No, you have to ask every time yourself why. So why this concept is there? Why make or buy? Why the lease or buy? Why this Q theory is there? What is the use of the Q theory? What will be the use of the Q theory in the times to come? So by this way that you will try to understand, because I am aware that you have to do a lot of preparation in the little time, but if you will go away with little away from the social media and all these things, you will find that you will have enough time available to prepare yourself. At our times, as rightly mentioned by Honorable Vice President, there was no facility like this. There was only one class. My elder brother used to tell me that there was only one class of Dr. Girish Ahuja in the ICI headquarter at the 6th floor. The students were sitting on the floor, and there was they were studying in the stairs rather than the facilities were available. Now you have all the facilities thanks to your parents as well today. Because of them only that you are pursuing this CA course and all the facilities being provided by them. and you should be thankful to the Almighty as well. So, my dear friends, I am very happy that the Board of Studies has initiated a new journey. It was a cherished dream since 2010. I am aware that in 2010, the then Honorable Past President Amarjit Chopra ji started this online virtual classes for the students, but later on, a lot of journey have gone, and now in 2020, once again, with the I will say the able dedication of the Devashish Mitra ji and Sushil Goyal ji, the chairman and vice chairman, we are once again starting this online virtual classes without any charge for the students. We have the recent success story of organizing the revisionary classes for the in the last 2 to 3 months, and I'm aware that even the Board of Studies faculties who are actually developing the material, understanding the subject, will be teaching you, will be guiding you in a number of classes at this in this duration, and that will be very, very useful. I request each one of you that you please always feel free to connect with the Board of Studies faculties, even to the chairman and vice chairman, so that any doubt if you have in your mind should be clarified at the same time, immediately at the same time, so that you can prepare yourself well. Friends, we are already explained, Honorable Vice President already explained you the various initiatives taken by the ICAI, made with the CDS portal, made with the online material, case study based analysis, everything. So I will not touch upon, but only I will convey you that we are working 24/7 to give you a wow experience of connecting with the second largest professional body across the globe. Please feel there. I just wish to once again tell you that there will be, I will say, the weakness here and there, because ultimately what is called SWOT analysis, the strength, weakness, opportunity and threat. Every system has strength, every system has weakness, but we have to see only the positive side of this story to remain positive in the life. So it is very, very important that you have to work hard, and you have to see that the institution, the entire ecosystem is trying to develop you as successful chartered accountant in the times to come. And I wish that the Almighty will bless each one of you in the times to come with the flying colors and become a successful chartered accountant. God bless to each one of you. Thank you to Honorable Vice President Sir for all the initiatives and the support, and the Devashish Mitra ji and Sushil Goyal ji for leading from the front on this for the cause of this profession. Thank you very much, sir.
Thank you very much, President Sir. You have spoken about passion, you have spoken about love for the course, you have spoken about the attitude and how to attain the altitude, you have spoken about being a future ready, and you have spoken about concentrating on gaining the skill sets. I'm sure the students who have heard you, they will feel extremely encouraged and passionate to take up this course. Thank you, President Sir and Vice President Sir, for your kind presence. But we have with us Sushil Goyal ji, the Vice Chairman of Board of Studies, who is working very hard. Sushil Goyal, if you could kindly offer a formal vote of thanks.
Thank you, Chairman. Thank you, Vice President Sir. Thank you, President Sir. First of all, happy CA Day to all the dignitaries present in this webcast and all the students who is watching, along with the BOS faculties. I wishing you this year in CA profession will bring colors to you, and definitely you will come with flying color. Our Vice President Sir has specifically mentioned that if you do hard work, nothing can stop you. And friends, I wish all of you that this CA course, through these virtual classes also, you will able to pass your exam this term only. So this is the wishes. President Sir has mentioned about the why things must come to our mind. Whenever we are learning something, we must see why it is being done. It is very important, friends. If you develop this habit, definitely you will able to deliver the requisite. So we are thankful for both the President and Vice President Sir for coming here and addressing students and motivating them on the CA day. We understand that the entire day is very busy day for both of them, and still they are here. We are thankful. I am also thankful to Chairman BOS for organizing these classes because his hard effort only bringing these classes to the student, and time is short. For final it is only 4 months. Still we are designed By increasing the hours, we will able to cover the course. We are thankful to the entire faculties of Board of Studies and the team Board of Studies. They are working day and night to deliver best to the student. And as Vice President Sir has promised, we will definitely able to deliver best of study material at your doorstep without any delay. Let the COVID be over. And President Sir, definitely I feel all the students will use all the guidance you have given to become better chartered accountant in the given time. Thank you very much, each one of you, for joining. Thank you.
म्यूट है देवाशीष मित्रा जी. हाँ म्यूट थे सर.
Yeah. So now we shall commence the classes. Vannaji, please, start off the proceedings. Once again, President Sir and Vice President Sir, thank you for your kind presence. Thank you, sir. Thank you.
Mr. Chinmay, Mr. Ganeshan.
Yeah, ma'am.
Mr. Ganeshan, you can start your class. Welcome.
Okay. You are able to see the PPT, ma'am?
Yeah, we are able to see it. Right.
The Chairman Board of Studies, Devasish, with whom I have worked in Accounting Standard Board and WASB for quite some time, and Vandana ji for giving this opportunity of sharing my thoughts with the students and developing them, as rightly pointed out by the President, future-ready chartered accountants with the complex accounting principles which is coming out of Ind AS, the IFRS Converged Indian Accounting Standard. Today we will be discussing on the very first standard, Ind AS 1, presentation of financial statements, which actually sets a tone for the entire presentation of the financial statement, whether it is a balance sheet, whether it is your profit and loss account, whether it's a statement of cash flows, whether it is the notes and accounts, whether it is a statement of changes in equity. So we will discuss at length, and before we start, we will also discuss a little bit of the overview of what we mean by Ind AS, because this being the first session, I think that I should also give you a little bit of guidance on what this is all about. I'm just saying that how the rules of financial reporting or the various financial reporting framework which we are talking about in India is being carried out. The first is, if you are talking about a non-corporate entity, the accounting standards have been issued by the Institute of Chartered Accountants of India. So accordingly, non-corporate entities will be outside the purview of Ind AS, and they will be covered by the standards issued by the Institute of Chartered Accountants of India. When we are talking about certain companies who are meeting the threshold limits in accordance with the notification given by the Ministry of Corporate Affairs for implementation of Ind AS in India, those companies will be following IFRS Converged Indian Accounting Standards, but we call them as Ind AS. So Ind AS is applicable only if the company is meeting certain threshold limit. The threshold limit may be based on the listing criteria, may be based on the net worth criteria. We will discuss that at length at a subsequent time. And the third possible set of standards is for the other companies who are not meeting the threshold limits as set by the roadmap issued by MCA for Ind AS implementation. The other companies will be following what we are calling as Companies Accounting Standard Rules 2006 as amended from time to time. For example, it was amended in 2016 as well. Some of the standards went for limited revision. Some of the standards have been totally new. So as far as we are concerned, we have three different financial reporting framework as of now. One for non-corporate entities. For non-corporate entities, Ind AS is not applicable. The other category is companies who are not meeting the threshold limit. For them also, Ind AS is not applicable. They will be continued to apply Companies Accounting Standard Rules 2006 as amended from time to time. Only if the companies are meeting certain threshold limit set by the roadmap, then we will be applying IFRS Converged Indian Accounting Standard, Ind AS. If you see, I am using the word IFRS Converged Indian Accounting Standard. I am not using Adopted Indian Accounting Standard. That means in India, we had previously somewhere around 32 standards, out of which 29 standards have been made mandatory and 3 standards on financial instruments are not made mandatory. So those 29 standards, when we have applied in the preparation and presentation of financial statement, is there a possibility of ignoring them every thing in one stroke and say from such and such date all those standards are not applicable, a new set of accounting standards will be applicable, is a big hardship on the entities as well as on the professionals and also on the users, because it has to be completely changed. So accordingly, what the Institute of Chartered Accountants of India in consultation with the Ministry of Corporate Affairs felt is that we will study each of the IFRS standards, whether it is IAS series standards or IFRS series standard, along with the Indian requirement, and wherever we believe our economy requires a different treatment, we have built in those items in our standards and converged our standards in accordance with IFRS. By saying this, you may observe that IFRS and Ind AS are not exactly same. There are certain differences which has been made or included for the purposes of Indian situation, and those changes which we have talked about, we will see in a separate slide. We call that as carve in and carve out. When we say carve in, we have included certain additional criteria or additional accounting treatment which is not available in IFRS for enabling the Indian companies to match with the Indian economy. One of the example is we brought in a concept called capital reserve in a standard called Ind AS 103 business combination. Whereas in IFRS, it is considered as gain on a bargain purchase and it is treated in the P&L account. That is, it's credited to the P&L account. But what we felt is when we buy a company and there is a surplus arising out of the consideration minus the assets which we have taken over, the difference should be always a capital receipt, not a revenue receipt. So it should not be credited to the P&L account. So we have made a carve in our financial, in our Ind AS standards. Similarly, there are certain carve out which we have done. One example which we will also see later is in Ind AS 1 itself we have made a carve out where it says that, for example, if a company has taken a term loan from a financial institution or a bank or from any other person, we normally take the term loan as a non-current because it is not repayable within the next 12 months. Only the portion which is repayable within 12 months, we will show current maturities of long-term debt and show that as part of the current liability. But the balance portion is normally treated as non-current liability. However, if there is any breach of terms and conditions, for example, if the condition says that the entity should maintain a current ratio of 1:1.33 during the entire tenure of the loan or outstanding of the loan, then every year we have to check whether the loan covenant is also met. In case if the loan covenant is not met, the bank will be having a right to recall the loan as repayable on demand. IAS 1, which is the equivalent standard for Ind AS 1, says if such a default has occurred, even if the bank has not issued any notice, that loan should be treated as current liability. We will see why it has to be treated as current liability, as the logic because there are 4 conditions by which you will decide whether it is a current liability or non-current liability. In fact, I got 2 questions already from the students, which I will answer that when I am taking the appropriate slide. So if the IAS 1 says it should be treated automatically as non-current liability because it's repayable on demand. Whereas in IAS 1, Ind AS 1, when we have converged this standard with IAS 1, we felt that in Indian situations, the bankers normally allow this type of defaults, and they also not call back the loan. That is, they are not sending the notice saying that it's repayable on demand because they are not met with the loan conditions. So they normally don't do it, and accordingly, in Ind AS 1, we put out a carve out saying that this rule in IAS 1 will not apply. We will see the actual professional factor where we are saying that this will be based on whether the bank has actually issued the notice and it is outstanding on that reporting date. If no such notice is issued, normally we will continue to classify them as a non-current liability. This is one of the carve out which we are talking about. In simple terms, we are not simply adopted the accounting standard which has been issued by IASB, both IAS series standards and IFRS series standard. Every standard has been converged with the existing accounting practices which we are having, and wherever we are acceptable the fact of IAS, we have retained as it is. Wherever there is a change which is required, whether we have brought in additional factors which we call it as a carve-in, or we have deleted certain principles which are considered to be carve out. So this is one of the principle which we have to see. That is the reason why we are using the word IFRS converged Indian accounting standard. Now, the question comes is that who is actually issuing the IFRS converged Indian accounting standard? Because we must also know that there should be a scenario of what we are going to consider, or what we are going to consider as part of our Ind AS discussion. Who is the issuing authority? If you see that the issuing authority here is the preparation of the accounting standards are done by the Accounting Standard Board of ICAI in consultation with the National Financial Reporting Authority. So the preparation of the preparation of the Ind AS standards are being done by means of the provisions which are available for the Accounting Standard Board. Because the National Financial Reporting Authority is the ultimate authority which is sitting on all the financial reporting related matters as per the new development. So it has to be consulted with the NFRA. After we have consulted with the NFRA, the final the draft goes to the central government, and central government Ministry of Corporate Affairs actually approves this, and it comes in the official gazette. Then it becomes a notified standard with a date which has been mentioned. So the Indian accounting standards are the set of IFRS converged standard issued by the central government and prepared by the institute. If you see that how the Ind AS are named and numbered, interesting point. Because if you see in AS, we have AS 1, AS 2, which talks about inventory, and AS 3 is talking about cash flow statement. If you see the numbering in Ind AS, you will see that, the discussion will be fully in English as per the instruction given by Board of Studies, because it is being seen by everyone throughout India, and accordingly it will be fully in English, not in Hindi, because many of the people who doesn't know Hindi is also there. So there will not be any mix of Hindi, sir. That is one reason. And another reason is I am not fully conversant with the Hindi fluency in speaking. So, but I will use a very simple English language. There is a question which is coming in from Sonali. What is IAS 1? IAS 1 is the standard issued by International Accounting Standard Board. When we are talking about the standards, which we are talking about is, okay, when we are talking about these standards which has been issued, when we are converging, we are actually taking the standards as issued by the International Accounting Standard Board, IASB, and IASB has issued two sets of standards. That's what I am about to say. IAS series standards and IFRS series standards. What is this IAS series standards? Before the introduction of IASB, the standard setting was done by International Accounting Standards Committee, IASC. When IASC was issuing standard, they were issuing up to 2001. They started issuing the standard with a series called IAS. IAS 1, IAS 2, IAS 7, like that they have started issuing the standards for each of the standards. Like we have issued IAS 1, they have issued IAS 1. What happens is, this up to 2001, IASC was issuing the standards, but they have felt that when the European Union and other countries started absorbing the International Accounting Standard, the board should be broad-based. So they felt that IASC is a small body. There should be a broad-based board which should consider the aspects of everyone who are using this, every country throughout the world who is using this. And accordingly, when the broad-based constitution has happened, they made IASC into IASB, International Accounting Standard Board. The International Accounting Standard Board has considered the existing standards issued by the IASC, because they have issued standards IAS 1 to IAS 41. There are 41 standards which has been issued, and they have considered whether that 41 standards has to be deleted completely, and we have to issue all standards as IFRS 1, IFRS 2, like that up to IFRS 41. There is a question which was before them. They also felt like what we have felt. The existing standards have been already used from time immemorial, and it is in the DNA of everyone present. So to that extent, they felt that if the existing principles of an accounting standard remains as it is, the IAS series standards will be retained. So accordingly, out of 41 standards, they have retained somewhere around 27 standards as of now. That's the reason why, if you see the numbering, IAS 1, IAS 2, then you have IAS 7. And when the concept is completely changing, what they have done is they have scrapped the standard and brought in a new standard with IFRS series. For example, when there is a change which is required on borrowing cost. In borrowing cost, previously IAS 16 equivalent to, IAS 23 equivalent to our IAS 16 borrowing cost is saying that the borrowing cost has to be either capitalized or to be charged to P&L account. That means the option is available. Even if it is relating to your qualifying asset, you can capitalize or you can charge it to P&L account. But these two options make the comparability of the financial statement not correct. And accordingly, it requires only a limited revision which has to be made. What is a limited revision? That paragraph which is talking about giving an option should be changed to say, if it is relating to qualifying asset, the borrowing cost should be capitalized. So accordingly, the capitalization has been made mandatory in case if it is a qualifying asset. That is a small change, right? So scrapping the existing IAS 23 and bringing an IFRS series standard, they felt it is not required. And accordingly, they had made a small limited revision to that particular paragraph, deleting the option and keeping as it is. So wherever they felt that the existing IAS series standards can be still used, they retained as it is. Wherever there is a change that the entire concept has to be changed, they have actually brought in new IFRS series standards. And accordingly, if you see this series standards, IAS 1 to IAS 41 we have in IASB, and IFRS 1 to IFRS 17 as of now in IFRS series standards which we are having. When we have taken that standards for the convergence, one of the questions which we are having is that whether we have to renumber them according to Indian concept. But globally, what other countries, whenever they have converged the IFRS standards, retain the existing number scheme of the IFRS. For example, if it is an IAS 1, and when we are adopting in India, we have decided to retain IAS 1 as Ind AS 1, IAS 2 as Ind AS 2, IAS 7 we took as Ind AS 7. So IAS series standards started with 1 and it went to 41. Ind AS 1 to Ind AS 41. In between, certain standards are not there. That numbers have been left as it is. We are not using it. That's the reason why when we are saying Ind AS 1 and Ind AS 2, in between 3, 4, 5, 6, those standards have been deleted in IFRS. So we are also not adopting. We are not converging them. IAS 7 is talking about cash flow statement. We are also taking Ind AS 7 as cash flow statement. Whereas the numbering of cash flow statement as per accounting standard, it will be AS 3, right? Here we are calling it as Ind AS 7 because we wanted to align with the same number, because these financial statements are not going to be used only in India. This will be used by stakeholders around the world. And if we are having a separate numbering system, people will get confused. So that's the reason why we retained the same thing. The challenge came was, if it is an IFRS series standard, how we will identify them. For that purpose, we have decided that IFRS series standards will be starting with 101. IAS series standard will be starting with 1. IFRS series standards will be starting with 101. For example, IFRS 1, first time adoption of Indian IFRS standards, is now called Ind AS 101, first time adoption of Indian accounting standard. Okay, so that's the way in which we have numbered. So Ind AS is named exactly in accordance with the IAS series standards and IFRS series standard, and the numbering also 1 to 41, 101 to 116 as of now, because the 117 which we are under draft stage, equivalent to IFRS 17, is on insurance companies accounting standard. As of now, we have not yet made mandatory because insurance companies roadmap is only by 2021. The discussion is going on. This is the preamble of what is Ind AS. So why will there be a detailed discussion on carve-in or carve-out? Yes, Jatin, I have a separate slide to talk about what is the carve-in and what is the carve-out. With examples also, don't worry about it. We will be doing it. Okay. Now we move to the next thing. We have talked about the carve-in and carve-out, right? That's what Jatin is asking about. I have said that whenever there is a deviation from the accounting principles and practices which are used in IFRS, but we have converged according to Indian scenario, we call that as a carve-in or carve-out. Carve-in means we are including something. Carve-out means we are actually trying to do something which are, for example, the carve-in is nothing but we are going to include certain items into our financial statement, Ind AS series standards, whereas carve-out is exclusion from IFRS. So whatever is IFRS standard, we are actually going to exclude them. The carve-in and carve-out we will discuss. And there are certain things which we have used as a carve-in. Two things, the carve-in and carve-out, we have taken as a mandatory carve-in and mandatory carve-out. One of the things which is pertaining to Ind AS 1, I have discussed about that particular carve-in, which you have actually understood, is classification of loans in case of breach. You remember that I have said that if a term loan is breached, it is actually going to be part of Ind AS 1. Okay. In Ind AS 1, we have made a carve out by saying that even if the breach has happened, nothing to worry. You can still have that as part of your non-current liability till such time the bank has actually issued a notice of recalling it. This is one of the carve out which we have done. It is a mandatory application. So that means there is no option which is available. The second point is relating to straight lining of lease rental. Some of you will be knowing that AS 19 leases says straight line method of accounting for lease rentals. Okay. So for example, if I am saying, if you pay 1 lakh rupees lease rental for the first year and 1,20,000 rupees, that is a 20% increase in the second year, and the third year is another 20%, 1,44,000 rupees. Your AS 19 says that all the lease rents for the 36 months has to be first calculated 1 lakh into 12, 1,20,000 into 12, 1,44,000 into 12 divided by 36 is the straight line lease rental which you have to account for from the day one into the financial statement. Okay, that straight lining when you do, you will do even if there is only 2% increase or 3% increase as per AS 19. Whereas in Ind AS we have said that only if it is beyond the expected escalation. So suppose if it is beyond the escalation clause, then only I have to consider doing this particular straight lining. This is as per the standard on leases which we have to consider, which is as per IAS 17, and our standard is Ind AS 17. Why I am using IAS 17 is we are numbering the same way. We are using the same number. IAS 17 says it should, there is no such exemption which is available. But Ind AS 7 says that do the straight lining only if there is a requirement for you to do this. Otherwise, it is not required. That's what your Ind AS 17 says. Having said that, one of the important point, yes, there are two questions which is coming in. So since this is the first thing, we will discuss this particular point when we are talking about will these slides will be made available after the class? Yes, it will be done. And any questions will be discussed with the institute material. 100% all the questions of the institute will also be talked about. Neelam is asking what is the roadmap. We will discuss about the roadmap with a detailed guidance. Don't worry about it. When we are talking about this Ind AS 17, one point I wanted to add that this Ind AS 17 has been repealed by means of Ind AS 116. Ind AS 116, new standard on leases. The new standard on leases is not talking about non-cancelable leases. What it says is that only if it is a short-term lease or a small lease, you can continue the existing treatment. Otherwise, it is talking about accounting in a different manner. It talks about sir, IFRS 17 is talking about insurance. Forget about IFRS 17. I am talking about IAS 17. So don't get confused on that. What you are talking about is IFRS 17 is for insurance contract. What I am talking here is a lease contract, which is Ind AS, and Ind AS 17 is talking about the leases. Now that standard has been removed by Ind AS 116. In 116, they have said if it is a long-term lease, it will be accounted in accordance with the right of use and lease liability. For the time being, I am not going to talk about Ind AS 116 because we have a separate session on Ind AS 116. Okay. So this is another carve out. If you are using the exemption given in Ind AS 17, your straight lining will be happening only if the increase in rentals, escalation rate, is more than the cost of inflation and the cost of index. For example, if your CAI index is only 8% inflation every year and your change in the increase in the rate is 5%, then you need not do a straight lining. That is exactly what we are talking about. And the third one is relating to your standard on here you have employee benefit standard where gratuity or leave encashment are determined based on your actuarial valuation. The actuary uses a discounting rate. the discounting rate as per IFRS should be high yield corporate bond rates. But in India, we are using government bond rates as the discounting rate, and we will still use that particular situation. M.K. Chidambaram is asking that question. So both the standards are there, Ind AS 17 and Ind AS 16 for leases, 116 for leases. No, because Ind AS 17 has been repealed the moment Ind AS 116 has been issued. If it is not, in case within Ind AS 116, you have certain standards which certain leases which are a short term. For example, it is only for 12 months. Then you need not apply the principles of what we call right of use asset or lease liability. You will understand that in detail at that point of time. We will deviate that. Ind AS 17 has been deleted, so it is no more there. Okay. One of the question which we are coming is Bhanuchandar, I think this you have to check with Board of Studies. I don't have an answer for that. They will answer for this. Ladhi, when you are saying that, what happens if you are cancelling this particular lease? It is actually a change in estimate. So you will account it on a prospective basis in that year in which it changes. But we are deviating from our Ind AS 1. And what I will stick on to is that if the questions are relating to Ind AS 1, I will retain that. If it is relating to other than that standard, please wait. Karan, I am not able to understand. So we make notes. Yes, you make notes of whatever you wanted to understand, because the slides will be made available to you, and you can now make notes about whatever I am explaining, because that will not be available in the this thing, right? Okay. Then we are coming to the gain on bargain purchase, which I have already talked about for you, right? So we said that in business combination, when the consideration paid is lower than the assets taken over, in India, as per AS 14, we consider them as part of capital reserve. But IFRS says it's a gain on bargain purchase and take it to the credit of the P&L. So it is, we have decided not to have that. So we have carved out that particular portion. And another thing is investment property. It is Ind AS 40 equivalent to IAS 40. IAS 40 says that, for example, investment properties means what? An entity has a 5-story building in which its corporate office is there. And one floor is used by the corporate office, and the balance 4 floors have been let out to others. So that 4 floors are kept for earning rentals, capital appreciation, not for carrying out its business. So it is not used for the administrative purpose of the business, and accordingly they are not meeting the criteria of a property, plant and equipment in accordance with your standard on property, plant and equipment. In India we call it as an Ind AS 16. So Ind AS 16 is different, that where the asset is used for your own administrative purposes, your own business purposes. Where you have let out on hire, Ind AS 40 investment property will be applicable. Under the standard on IFRS, IAS 40 says investment property can be considered on cost model, or investment property can be considered based on fair value model. The fair value changes. 1 year I have valued at 100 crore, and second year it is 110 crore. The difference in the fair value, 10 crore, will be taken to the profit and loss account is what IAS 40 is saying. But we felt that this is not acceptable to Indian scenario. So we have deleted the option which has been given. So that means Indian company should apply only cost model as far as Ind AS 40 is concerned. This particular item, classification of expenses, is relating to Ind AS 1. When I am coming to the particular presentation of profit and loss account, I will discuss at length. This is how the expenses has to be presented on the profit and loss account, is what the carve out which we have done compared to IAS 1. We will discuss that when that particular standard comes in. Apart from that, there are certain things which has been taken as a optional carve out. For example, in AS 11 you might have already read. For example, when you are talking about you took a foreign currency loan for the purposes of depreciable asset, you have the option of capitalizing the forex losses as part of the capital asset and depreciate over the remaining useful life of the asset, right? So that option was available only in AS 11. Equivalent standard in Ind AS is Ind AS 21. Ind AS 21 has allowed that existing option for the old contracts. For the new contract, it was not available because this option is not available in IAS 21. When we are converging with IAS 21, we have said all forex losses should be debited to P&L account. No capitalization, no deferment. So when some companies have already used it, asking them to charge everything to P&L account will have a huge impact. So we have told them that for existing contracts which has been entered into by the company before it going for Ind AS can follow the existing principle. For the new loans which they have taken, it has to be charged to the P&L account. But this is an optional. When I am saying optional, entity can use this or entity can simply charge it to P&L. Both options are available. And similarly, when you come to Ind AS 110, Ind AS 1111, these are relating to consolidation standard. We normally look for the accounting principles of associate and the parent should be equal, right? But if it is impracticable in some scenario where you have invested in a company which is an associate company, but you are not getting any information from them, in that situation, it says that if it is impracticable, you can have a different policy and the parent can have a different policy and you can adjust for only the accounting policy differences. Okay, that is one of the optional exemption which is given. That is also taken care. Another interesting point which we have talked about is, first time when I am adopting Ind AS, I have to take the opening balances. From where I will take the opening balances? I have only numbers audited as per AS. That's the accounting standard. Can I take the balances as per AS and take it to Ind AS? The Ind AS says you have to apply the principles in accordance with the Ind AS. If that is different from AS, how I can take that? For that purpose, there is one standard on Ind AS 101, first time adoption of Indian accounting standard. There is a separate session, so I am not discussing that. Here what they said is that in respect of property, plant and equipment, whatever is the carrying amount as per the previous GAAP, that is whatever is audited as per AS, can be taken as a deemed cost. This option is not available in IFRS. So we have taken this as an option. Again, it is an option. You can use it or you need not use it. And this is relating to toll roads and other things where you got a permission from the government to lay the roads and operate the toll booths for 30 years and 40 years. And how you are accounting? In India, we are accounting the toll road cost as part of our intangible asset, depreciable asset, and we depreciate whatever income which we are collecting from the toll, we are offering that as an income from operations. So it is permitted to maintain the same thing as an option. These are all the carve in and carve out. These are all the carve in and carve out. Disha, when you were asking the question about what is the discount rate at the government securities and not corporate bond rate, very simple, because in India, corporates are both private and public, and we are not very sure is it correct to go for high yield government corporate bond rates as the basis, whereas the government bond rates are controlled by the government, and the government bond rates is also monitored by the Reserve Bank of India. So we felt that that will be a more logical conclusion. That's the reason why we have kept that as part of our standard. Now, when we are talking about the Ind AS applicability, which we have to see, I talked about certain companies based on threshold limit will apply the standard and certain companies will not apply this because there is no requirement. I just give you this particular scenario. What is the criteria for Ind AS applicability? Please understand this. Somebody has also asked what is the roadmap, right? The roadmap is nothing but the Ind AS applicability criteria when you have to start preparing and presenting your financial statement in accordance with Ind AS. When you can say that Ind AS is not applicable, I will wait for meeting the threshold limit. When? That is exactly what we are talking about as a roadmap. Somebody has said, what is the roadmap? And I said, I will take it forward and discuss that particular point. Now we are coming to that particular question. The question is, companies are divided into, for your understanding, I am dividing that into three major criteria. One is based on net worth. That means if the company's net worth crossed a particular limit, they have to follow Ind AS. For the time being, you please understand, any company which has crossed a net worth of 250 crore, for example, if you are talking about 2021, if they have crossed the net worth of 250 crore, they have to necessarily follow Ind AS. That is a requirement. But the roadmap, when we have talked about, it started with 2015, and accordingly there are some other differences are also there. I will explain in the next slide. So net worth is one of the criteria. How to calculate net worth? We will have some examples for you to understand. Don't worry about it. Net worth is one of the criteria. The second criteria which we are having is that companies based on listing, whether it's a listed company or unlisted company. If you say it's a listed company, automatically they are covered as part of Ind AS roadmap, because all listed companies presently has to adopt Ind AS. Initially, they have been given certain timelines wherein which they have to do it. That is what we are talking about, phase 1, phase 2, etc. We will discuss that phase 1, phase 2. If you ask me today, all the listed companies has to follow Ind AS. And the third principle which we are talking about, suppose a company is unlisted, but they wanted to go for listing, right? If they have announced that they are going for proposed listing of the shares, and board has taken the decision and it has been publicly announced, we call them as a proposed listed company. That means they are going to list in the stock exchanges, and to that extent they are proposed listing. All these three companies are covered by IFRS Converged Indian Accounting Standards, or Ind AS. Okay. So basically we are seeing three criteria: net worth criteria, listing criteria, proposed listing criteria. Interestingly, we are taking an example of an unlisted company. Can we take an example of an unlisted company? So where the unlisted company will come, listing requirement will not be met, so this will not met, so this will not apply to an unlisted company. Proposed listing, assuming that the unlisted company is not proposing to do that, this will also not apply for the unlisted company. But this will apply in case if the net worth is beyond 250 crore, that unlisted company will be covered by Ind AS. If it is less than 250 crore, we said Ind AS is not applicable. If you recap what we have discussed about the three sets of accounting standard, for companies who are not meeting the threshold limit, they will follow Companies Accounting Standard Rules 2006 amended as of now. And these accounting standards you are already familiar with, right? What we are going to do is that what you are familiar with, how we are going to learn the new standard. That's the way in which we are structuring the entire discussion. So unlisted companies may be covered only based on meeting the net worth criteria. For listed companies, it has to be necessarily follow irrespective of the net worth. For example, if a listed company is having a net worth of only say negative net worth, still they are covered because they are covered by means of listing criteria. In respect of the other category, proposed listing companies may not have a negative net worth, but they may be having a net worth less than 250 crore. In that case also they have to cover the net worth criteria applicable only for unlisted company. Okay, we have said this. Now the question is, suppose if I am, so A Limited is a listed company which has to mandatorily apply Ind AS. B Limited is a B Private Limited. We will say that B Private Limited is the private limited which is the holding company of A Limited, or B Limited, B Private Limited is a subsidiary of A Limited, or B Private Limited is an associate of A Limited. B Private Limited is a joint venture of A Limited. So A Limited already adopting Ind AS, and all the holding, subsidiary, associate and joint venture of the companies covered by Ind AS should mandatorily follow Ind AS. That means irrespective of their net worth, irrespective of their listing, irrespective of whether they are proposed listing, the moment I say B Private Limited is a subsidiary of A Limited, A Limited already follows Ind AS, B Private Limited should also follow Ind AS on a mandatory basis. So the 3 is the primary criteria, and the group companies in that company group should also follow. This is a subsidiary classification which we have to consider. So now you are very clear. Unlisted companies, we go with net worth criteria. Listing and proposed listing mandatory we will cover. Any company which is a holding, subsidiary, associate or joint venture of those 3 categories of companies covered by Ind AS should also follow Ind AS irrespective of their net worth or a listing or proposed listing. So you are clear. Now we go for the road map. So we will understand what is a road map. The road map is very simple. The idea of giving a road map is that instead of asking all the companies to adopt Ind AS from a particular point of time, the Ministry of Corporate Affairs felt that India should give time for the readiness of application of Ind AS for the companies. And accordingly, they have classified the companies based on higher net worth and smaller net worth companies, and said that the first phase will be applicable to higher net worth companies, second phase will be applicable to other companies. Similarly, when they have issued a notification for non-banking finance companies, how they have to follow, higher net worth non-banking financial companies have been asked to follow Ind AS first, and for others it has been made as a requirement in phase 2. That's what exactly this roadmap is all about. So accordingly, we should understand the roadmap: general companies, non-banking financial companies, banking companies, insurance companies. There are 4 different categories of roadmap. General companies means they are not non-banking finance companies, they are not insurance companies, they are not banking companies. Other than those companies are considered as general companies. For general companies, the roadmap has been given like this. The roadmap has said that based on, if you see this, for the benefit of your understanding, I am splitting that into 3 categories which we have discussed before. But if we really see, for the accounting period commencing on or after 1st April 2016, means for 31st March 2017, Ind AS has been made mandatory to certain companies based on the threshold limit. What is that threshold limit? 1, 2, 3. There are 3 threshold limit which was there. First threshold limit, what it says, listed companies and proposed listed companies and having net worth of 500 crore or more. Not all the listed companies, not all the proposed listed companies have been covered. Only those listed companies and proposed listed companies which are having net worth of 500 crore or more, big companies, right? That's what I'm saying. Big companies are covered first and other companies are covered next. So listed and proposed listed companies for the year ending 31st March 2017 is covered under Ind AS only if their net worth is 500 crore or more. Similarly, for unlisted companies also, they will be covered for the year ending 31st March 2017 only if the net worth is 500 crore or more. Otherwise, it is not covered. The third category remains as it is. Suppose if this company is a holding company, subsidiary company, associate company of any of the company which is having net worth of more than 500 crore, then this company has to necessarily cover irrespective of the net worth. Here the net worth is not the criteria. Okay. So here net worth is not applicable. I have to simply see I am related to this company or I am relating to this company. If I am relating to this company as a holding company, subsidiary company, associate company or joint venture company, I am automatically covered as part of Ind AS. This is phase 1. Now the phase 2 which we are talking about is basically talking about other companies, right? It says for the accounting period commencing on or after 1st April 2017, that means 1st April 2018, 31st March 2018, if we are talking about any company which is having one second, I will go to that there. Okay, so the question which we are having is that what happens in case if you are talking about a company which is having net worth of less than 500 crore. If we are saying that the net worth is less than 500 crore, then we are supposed to recognize, or we are supposed to consider them not in the year ending 31st March 2017. We have to consider them only for the year ending 31st March 2018 based on this criteria. What is the first criteria? Listed companies and proposed listed companies, all companies are covered which are not covered in phase 1. That means if their net worth is less than 500 crore, even if it is negative net worth, the listed and proposed listed companies are fully covered for the year ending 2018 March. That's what I have said in the previous slide. 31st March 2018, fully covered. When we are talking about a case of unlisted companies, they have fixed a net worth criteria. They have said net worth is 250 crore or more, but less than 500 crore. So if any entity is having less than 250 crore, they are not covered. That's what initial 3 accounting standard list which I have talked about. I said unlisted companies having net worth of less than 250 crore will continue to apply the present accounting standard. They will not get into Ind AS. Okay. So if unlisted company is more than 250 crore but less than 500 crore. Why less than 500 crore? If it is 500 crore or more, it is covered in phase 1. So because it is less than 500 crore but more than 250 crore, it will get covered in phase 2. Right? So unlisted company net worth more than 250 crore is presently covered. This criteria remains the same. The moment an unlisted company is covered, then it is automatically covered. And listed company is covered, automatically the holding company, subsidiary company, associate companies are also covered. This is phase 2 in respect of general companies. What is the summarization which we can do on this? Today, if we are talking about Ind AS applicability, all listed companies are covered as per Ind AS. All proposed listed companies are covered by Ind AS, and no net worth criteria has to be attributed for them today, right? For example, a company is adopting Ind AS for the first time for 20 March or 21 March. I am not going to look into whether net worth is 500 crore or less than 500 crore. I am not looking into. I am simply saying if it is listed company or proposed listed company, Ind AS is straight away applicable. If I am talking about unlisted company, today, if the unlisted company is having a net worth of 250 crore or more, they are supposed to follow. And the holding, subsidiaries and associate and joint venture companies of the companies covered under Ind AS has to mandatorily covered irrespective of the criteria of listing, irrespective of the criteria of proposed listing, irrespective of the criteria of net worth, it will be get covered. That's what the requirement for Ind AS roadmap for general companies. Now, we have a question on NBFC. What happens to NBFC? NBFC, they have said that they will be following only from 2019 March. So they will not follow from 2018 March. It will be followed only from 2019 March. So what do you mean by 2019 March? If you understood the phase 1 and phase 2 of general companies, you can understand the same thing here also. So listed and proposed listed companies having a net worth of 500 crore or more, unlisted companies having a net worth of 500 crore or more. Here net worth is the only criteria for the year ending 31st March 2019. But the holding company, subsidiary company, associate company, joint venture company, etc. are covered the moment they are covered irrespective of the net worth. So 500 crore or more net worth NBFCs are preparing for 2019 March, and phase 2 is for other companies, listed and proposed companies, irrespective of their net worth, is covered in 2020 March. Accounting period commencing on or after 1st April 2019 means 2020 March. And unlisted companies, only if their net worth, NBFC's net worth is more than 250 crore, it will get covered in 2020. But the holding subsidiary associate goes as the mandatory threshold limit to follow Ind AS if the parent company has followed the Ind AS. Okay, this is phase 1 and phase 2 for NBFC. My suggestion is please consider this particular situation based on the same category. Only thing changes is the date of commencement. Here we have said 2016 for general companies. Here we have said 2017. Only 1 year plus in the category, 2 year plus actually in the category is changing. All other things remaining the same. This is actually a practical way of understanding the roadmap. Then we talk about banks. What happened? Banks have initially supposed to prepare from 19 April, that means 20 March, but it has been deferred by 1 year, and later on now they have deferred without any specific timeline. So there is a notification which has been issued by RBI, and RBI deferred without any particular time period. That means Ind AS is presently not applicable for the banks. Banks will prepare as per the existing accounting standard. For insurance companies, this is applicable from 2021. So that means 2021 is the first year of commencement. So for the year ending 31/3/2022 will be the first year. 1 year comparative will be for 31st March 21, and holding subsidiary associate every company should also follow. As of now, the insurance standard is not yet notified. That's the reason why this is postponed to 22 March. So this is applicable to be used for both consolidated and individual financial statement. So this is what is the question. I will first raise my own questions and answer. If those questions are not raised by you, I will take up your questions as well. The question comes is how you will actually identify the net worth. The roadmap notification says it will be applicable from the as of 31st March 2014. Whatever is your net worth as of 31st March 2014 as per the standalone financial statement. You should not see the consolidated financial statement. As per the standalone financial statement of an entity, what is the net worth you have to see? That net worth, if it is more than 500 crore, phase 1 coverage. If it is less than 500 crore but more than 250 crore, it is covered in phase 2. If it is an NBFC, it is covered in NBFC's phase 1, NBFC's phase 2. So net worth is calculated based on 2014 number. And as we have said, we have to look into applicability of Ind AS. Don't say that I will prepare Ind AS financial statement only for standalone. The moment Ind AS is applicable for an entity, if the entity has a subsidiary, associate or joint venture, it should prepare both standalone as well as consolidated as per Ind AS. That is another requirement. When we calculate the net worth, the standard says is that you should not include revaluation reserve in calculating the net worth. Similarly, if you have amalgamation reserve, that should not be included. You should not include any write back of depreciation done previously in the reserves. That should also be not considered. So there are 3 items which has been excluded from computing your net worth. Take the net worth as on 31/3/2014. reduce revaluation reserve, reduce write back of depreciation, reduce amalgamation reserve. That is the net worth. For example, if one of the question comes in your examination where it says that the net worth as on 31/3/2020 is 270 crore, which includes a revaluation reserve of 40 crore. Find out the applicability of Ind AS for the entity. Then net worth should be based on what is the net worth as per the Companies Act. And so 2014 is the starting point. Subsequently, companies may be having a net worth later on. We'll discuss that little later. So if it is 270 crore net worth and I have 40 crore of revaluation reserve, 270 minus 40 is only 230 crore. Because 230 crore is less than 250 crore, Ind AS is not applicable to that company, which is an unlisted company. So you have to be very careful about these three elements which are not part of the net worth. Okay. Once Ind AS is followed, it has to be necessarily followed subsequent years, even if the net worth has come down below 250 crore for unlisted company. Even if the entity is becoming delisted, previously listed companies will be following Ind AS. Now even if it is delisted, they should follow Ind AS on a mandatory basis. It's like a one-way traffic. Once you came in, you have to necessarily follow that particular principle. Continuing this question, you may ask, sir, listing when you are saying, my client or the entity which I am seeing is not listed its equity shares. It has only listed its debt instrument. Whether they are covered. As per the roadmap, both equity as well as this, both are covered. That means if unlisted company has listed its debentures in a stock exchange, then that is also considered as a listed entity. Only one point I wanted to tell you, but for this particular examination that the revision will not apply. As per the stimulus package which has been issued for COVID 2019, one of the conditions which they have said was, if it is an unlisted company and they have listed only the debt instrument, they will not be considered as a listed entity according to the circular which has been issued based on that. But that will be applicable only for your next attempt, not for the current attempt. As of now, whether equity shares are listed or debentures are listed, it should be considered as a listed entity. So you have to mandatorily apply Ind AS for that particular entity. The next question which you may ask is that, sir, listing has not been done in India. I have gone to Singapore Stock Exchange where I have listed my equity. So in that particular situation, whether I am covered, because I am not a listed company in India. In India, I am an unlisted company. Whether it is covered, again it says that both Indian and foreign stock exchanges are covered. That means whether you have listed in Indian stock exchanges, Bombay Stock Exchange or National Stock Exchange, or you have listed in your Singapore Stock Exchange, wherever you have listed, you are supposed to follow Ind AS. Only exemption for listing is that SME Stock Exchange. Suppose if you have listed in SME Stock Exchange, you are exempted from applying Ind AS provided your net worth criteria is not met. Because a company can have two possibilities. No, net worth is 260 crore. It is also listed in SME Stock Exchange. What will happen? SME Stock Exchange is not considered as a listing. So accordingly, listing criteria you are exempted. But net worth criteria more than 250 crore. When you have more than 250 crore, automatically you are covered as per the requirement of Ind AS, right? So you have to necessarily has to consider that particular company because net worth criteria is met. If the net worth is less than 250 crore and I have listed in SME Stock Exchange, then you don't require Ind AS at all, right? You have to be careful on that. And the next question is, you are saying that an insurance company, holding company, subsidiary company, associate company has to necessarily follow Ind AS if the parent company is following Ind AS. Suppose if banking company or insurance company is a holding company, right? What will happen? Because for banking company, it is not yet notified. For insurance company, it is not yet notified. Then their subsidiaries, their associate and joint ventures also not under Ind AS. What we have to do is, not based on the group criteria we have to see, but we have to see from the standalone criteria of that particular subsidiary, holding company or associate company or joint venture company. What is the individual standalone basis I have to see? Whether it is a listed company. If you say it is not listed company, not covered. Proposed listed company, no, not covered. Unlisted company, what is the net worth criteria? 250 crore, not, it is less than 250 crore. In that case, the holding company, subsidiary company, associate company and joint venture company of that company is not covered in phase 1 and phase 2, both for NBFC as well as general companies. Okay. But because of the group structure. But if individually they have listed, individually they are proposed listed, individually they have met the net worth criteria, they should automatically apply that particular rule. The only question which may come is a similar logic. We are talking about holding company, subsidiary company. Now NBFC is the holding company or subsidiary company. Now NBFC is already following Ind AS, and accordingly their subsidiaries, associate and joint venture will also follow. But one question which is still remaining is that suppose when I say the holding company is a non-NBFC, okay, it is not or it is an NBFC, it is not a banking company, it is not an insurance company. So what we will do, and it has a subsidiary of an insurance. So subsidiary, this is a subsidiary. So what our rule says, if the parent company is following Ind AS, assuming that they are already Ind AS, these two categories are already in Ind AS. So any subsidiary of a non-banking finance company which is following Ind AS should follow Ind AS automatically. The exception is, in case of banking company and insurance company, Ind AS is not made mandatory, and accordingly, those subsidiaries should not follow Ind AS. Only when Ind AS has been announced for banking companies and insurance company, they should follow Ind AS. Up to that period, they should not follow Ind AS. But what will happen for consolidation? Consolidation, the standalone financial statement and my financial statement, the accounting policy for the standalone and consolidated should be remaining the same. So accordingly, subsidiary should also have the same accounting policy. So for that particular purposes, consolidation, you will make an Ind AS adjustment. For standalone, that banking company and insurance company will not report as per Ind AS. Okay. So it's very clear based on the group structure. Now one question which I have started talking about is that net worth today. But whereas I started with saying that net worth is as of 2014 March is the starting point. So what happens if the net worth is met subsequent to 31st March 2014? So in 31st March 2014, the net worth of an unlisted company is less than, say, 250 crore. It was 125 crore. 2015, 16, 17, 18, 19, 20. That is 1st January 2020. If you see the profitability over the period of time, it has crossed 250 crore. Net worth has crossed 250 crore during 2020 March. So in that particular situation, what I am supposed to do? I am supposed to take out the entire thing in the immediate next year where I have met the threshold limit. So for in this case, we are saying January 2020, it met the threshold limit of 250 crore. So accordingly, immediate next year. What is immediate next year? Accounting period commencing on or after 1st April 2020 will be the application of Ind AS. So for this company, the moment it has crossed the 250 crore, immediate next year, we have to start applying Ind AS for unlisted company. What happens if you are talking about a listed company? or proposed listed company. 2014 it is not listed. 2015 not listed. 2016 also not listed. 17, 18, 19, 20 October they have 20 January they have taken the call that we will go for listing. So it is a proposed listed company, and the listing has been completed before 31st March. Can I say like net worth criteria where we said immediate next year is the Ind AS applicability. For listed and proposed listed company, the year in which that decision has been made, the status is moved from unlisted to listed or proposed listed, same year is applicable. Here it is year plus 1, right? But this is same year. So in our example, if the proposed listing has happened on 1st January 2020, 31st March 20 itself you have to prepare as per Ind AS. Whereas here, net worth criteria 250 crore is more than 250 crore, year plus 1, then 31st March 21 is the year of your applicability. You are clear on this? Net worth criteria not met in 2014, subsequently met. Immediate next year is the applicability. Previously it is unlisted as of 31/3/2014. Now it is listed, or now it is proposed listed. Same year is the applicability. As I have already said, if it is not covered by means of net worth criteria, not covered by listing criteria, not covered by proposed listed criteria, not covered because it is not group company, that is a holding, subsidiary, associate and joint venture of the company covered under Ind AS, then you will be following the existing accounting standard, no change, right? Okay. I think I have a problem of connecting to your questions. What I will do is, if the connecting issue is having a problem, I will download the questions and we will discuss that questions after the break. What I will do is, I will give you a 5 minutes break for convenience and we will come back. This is according to my watch, it's 8:45 now. We will have a 5 minutes break and 8:50 we will reassemble. In the meanwhile, I will download all your questions and then try to answer, because the live site is not working. I will download the questions and I will answer. For the time being, I am cutting my video and I will also cut my audio as well. So 5 minutes break from now and we will come back. Okay, let's start. If you see that the way in which the flow goes in our entire discussion of Ind AS 1, somebody has asked the question that whether the discussion will be based on the Board of Studies, and will you consider all the illustrations or questions which has been there in our study material. The flow itself is in accordance with the study material. That means that whatever you are seeing is in the same way the study material is going in, and accordingly when you are revising for your examination also, you can use this as part of your revision paper. And we are trying to cover all the illustrations within the time which is available for this particular session. That's the reason why the Board of Studies has felt that we will have 2 sessions for Ind AS 1. So today I will cover up to a particular level, because it consists of overview, discussion on Schedule 3, and then comes to Ind AS 1, right? So to that extent, there could be additional time required for us, so which will be done on the second session, which is allotted to me on 3rd July. We will cover on 3rd July in full, whatever we have left out today. But what we are planning is to take out the illustrations from the Board of Studies study material which has been given, and we will answer what is the logic behind that answer also we will discuss. That's the way in which I am planning to do it. So when we are talking about the Ind AS and the Schedule 3, what is the interplay between these two? 2 questions have already came relating to that even before we started the session, and I will explain this during the course of my discussion on Schedule 3. If you are a normal company, what do you mean by normal company? Which is not covered by Ind AS. And we said Accounting Standard Rules 2006 as amended by 2016 should be applied. Ind AS is not applicable to them. So those companies, you have to use Schedule 3 to the Companies Act 2013, Division 1. So the Division 1 talks about what is the format and content should be used for balance sheet, P&L, cash flow statement, notes and accounts. Okay, that is for other than Ind AS companies, Schedule 3, Division 1. For normal companies with Ind AS, when I am using the word normal companies with Ind AS, the reason is there are NBFCs, there are insurance companies, banking companies. So I am excluding NBFCs, banking companies and insurance companies. Normal companies with Ind AS is applicable because of net worth criteria or listing criteria, proposed listing criteria, or because they are group company of a company covered under Ind AS, whatever we have seen up to that particular point of time. For them, Schedule 3, Division 2 is applicable. Okay, so very clear that format and content is coming based on that particular situation. And when we are talking about NBFC, because as of now we have seen NBFC is also supposed to follow Ind AS. 19 March and 20 March is the 2 period, phase 1 and phase 2, we have already seen it. Now we excluded companies or banking companies and insurance companies because the roadmap is not yet made mandatory for them. For NBFCs with Ind AS, requiring Ind AS, they will follow Schedule 3, Division 3. What is the difference between Schedule 3, Division 1, Division 2 and Division 3 is, in Division 1, it comes with our existing practice of the presentation. Whatever we start with, we normally show with the share capital, reserves and surplus, non-current liabilities, current liabilities, etc. That format remains the same as per Division 1. In respect of Division 2, what happens is, it is as per IFRS prescription and what we have adopted as part of the Companies Act. When we are talking about this particular format, what it starts is, it starts with non-current asset, not starts with share capital and reserves and surplus. Starts with non-current asset, then current asset, the total of that, how that is represented in the financial statement by means of your share capital, other equity, that is the reserves and surplus, and then non-current liabilities, current liabilities. That's the format which is being used for this particular Ind AS companies, which are normal Ind AS companies. Here, if you see, current and non-current classification is the driver for asset side as well as the liability side. Whereas in NBFC, somebody has asked the question. So liquidity is also allowed as the basis as per Ind AS 1. But Schedule 3 is saying only current and non-current classification. Why should we follow that? Why that option should not be followed? If I'm not wrong, that question came from somebody from Chennai. So the answer is very simple. Schedule 3 is notified as per the Companies Act 2013, as per section 133 of the Companies Act 2013. You know pretty well, this is section 133 of the Companies Act 2013. It is notified as the accounting standard to be followed. And this is read with two things: Companies Accounting Standard Rules 2006 and Companies Accounting Standard Rules 2015 initially, right? The 2016 is nothing but this one. 2015 Companies Accounting Standard Rules 2015 is for these two companies, right? Nothing but Companies Accounting Standard Rules 2015 is prescribing the Ind AS, whereas 2006 is prescribing only a non-Ind AS, existing accounting standard applicable to company. But both are notified as per section 133 of the Companies Act, right? Perfectly all right. Now, what has given in the roadmap to Ind AS is that if the Ind AS is having some principles which are not in accordance with, or it is having a deviation from the Companies Act, then Companies Act will prevail over the accounting standard. That means if Ind AS is saying something, but Companies Act is saying different thing, then the Companies Act will apply, but not the Schedule 3. But not Ind AS. So Ind AS to that extent will be changed in accordance with the requirement of the Companies Act. Since the Schedule 3 has been notified as part of the Companies Act 2013, whatever is prescribed as per Schedule 3 should be applied if there is a deviation with Ind AS 1. So Ind AS 1 says, for example, you can present as per current and non-current classification. Where it is more relevant and reliable, you are permitted to have a liquidity basis of presentation. Both are there in Ind AS 1. That's what the first question which has come. It is a relevant question now. I am taking it. But since we are having the roadmap which says that to that extent, the company, the law prevails over the Ind AS 1. Law has notified Schedule 3. You have to follow current and non-current classification. Very simple, right? The other part is that when it comes to Division 3, what is the difference between these two? What is the difference between these two? Very simple. Here, current and non-current classification is the basis. Here, liquidity is the basis. So, in a non-banking finance companies, we always wanted to know what is the quick liquidity which it can make by, maybe it starts with cash balances and bank balances, etc. And how it is actually funded. That's the way in which the presentation of financial statement for Division 3 is being done. So liquidity basis is available, applicable to NBFC. Current and non-current will be applicable for non-NBFC. So Division 2 is current and non-current. Division 3 is your liquidity basis of accounting. So because Companies Act prescribed like that, liquidity basis is not applied for other companies, even though Ind AS 1 says if it is relevant and reliable presentation, in those circumstances, you can use liquidity basis of accounting. Now we don't apply for normal companies. Only for NBFC, we apply. When we are going to NBFC, whether there we will show current and non-current, no, we will not show anything as current and non-current. Based on the category of the particular asset, based on the liquidity, it will be structured and given. That is what NBFC model. So now, to understand this further, this requirement of Schedule 3, somebody has asked this question also. Why the deposit which we are making to electricity companies and gas companies or taken by the security deposit taken by electricity companies and gas companies are little different. The reason could be based on this, the requirement of India's Schedule 3 will not apply. The format will not apply for insurance company and banking company because as of now we have not notified Ind AS for them mandatorily. So they follow their own principle. IRDA will define what is a format, banking company, and any company which is engaged in the generation and supply of electricity. So not applicable. Okay. And it will not applicable to any other company for which a format has been differently defined by any other act. So that means the act will prevail over the format also. And Ind AS 1 will also not applicable for insurance company, banking company or company, these two companies because they are not in the roadmap. Having said that, there are certain guidelines which has been issued by SEBI because listed companies, what it says is that the format of financial results, every quarter a listed company has to report the unaudited results or audited results as the case may be with the stock exchanges. For that, SEBI has prescribed a format. That format more or less is equivalent to Schedule 3, but there are some deviation which is available. But in that case, if you see that we are saying any other format under any other act has been defined because they are governed by a separate regulations, SEBI listing and other disclosures order 2015, that format will be used for publishing the financial results on a quarterly basis, only for the purpose of stock exchange. When you are presenting the financial statement for approval by the shareholders, you will follow the Schedule 3 format. Okay, that is another interesting point which we have to consider. Now, Schedule 3 to electricity holding companies, what it says that it has not prescribed any format. It has not prescribed any format according to the Electricity Act. But what we are saying is that the format is not applicable to electricity companies. But then how they will present that financial statement? It says the Electricity Act, Section 1, Subsection 4 says that Section 1, Subsection 4 of the Companies Act says that it is also applicable to electricity companies to that extent there is an inconsistent with the provisions of the Electricity Act. That means to that extent there is an inconsistency, we will apply this act. So to that extent, in case Ind AS 3 as applicable may also be followed till such time another format is defined by electricity holding companies. And accordingly, if you see, the electricity generation companies and distribution companies are also following Schedule 3 format. Okay. So what is not yet answered is why the security deposit should be non-current liability or current liability. I will come to that current and non-current classification where I will take up this particular situation. Okay. What is the conflict? That's what I have said between Ind AS and Schedule 3. What it says that the disclosure requirement of Schedule 3 is over and above what is required by Ind AS. That means if Schedule 3 is additionally asking something to be done, then Schedule 3 requirement should also be included in accordance with that particular requirement. And what it says that this disclosure will be given as an additional statement or by way of notes and accounts. But normally in India, we prefer to have that as part of the notes and accounts. They disclose the information required by Schedule 3 over and above your Ind AS 1. Okay. So this is whenever there is a conflict between Ind AS and Schedule 3 on disclosure requirement. Now, as I have said, the Ind AS is Ind AS 1 to Ind AS 41. Ind AS 101 to Ind AS 116. So those are the standards which we have to cover. The session plan which they have had is that it will be covered in full. All the standards will be covered in full in accordance with the requirement of the study material and what Board of Studies is instructed for the benefit of the students. Okay. So we are not deviating from what is the instructions given by Board of Studies as well as by the study material. And accordingly, this whatever discussion I am going to do or my fellow faculties who will be doing from tomorrow onwards will be straight away is useful for your benefit. And really I appreciate the Board of Studies for such an initiative, because it serves the entire purpose of how it has to be prepared and presented. Now, we have covered the first part of Ind AS 1 as per your study material. We are coming to the second part of your study material on Ind AS 1. Now, we are actually going into Ind AS 1 straight away. Before that, we have talked about the overview, which was part of your study material. Now, the objective. What is the objective for which I am having this? It is actually providing a basis for preparation of the general purpose financial statement to ensure comparability. Comparability is for the same company in different periods, same company with its peers, similar companies. So that is what it's a period. That's what compared with the previous periods as well as the financial statements of other entities which has been presented as per Ind AS. That is what standardization is trying to combat. When we are talking about standardization, it also comes as part of your Schedule 3 requirement. What is the scope? It applies to consolidated financial statement which is prepared as per Ind AS 110. It also applies to the standalone financial statement which are prepared as per Ind AS 27. So Ind AS 27 talks about the standalone financial statement. That means when an entity prepares its own financial statement, that is called a standalone financial statement. An entity has subsidiaries, associate and joint venture. It has to necessarily prepare a consolidated financial statement as per section 129 subsection 3 of the Companies Act. Section 129 subsection 3 of the Companies Act 2013. Consolidated financial statement is required to be presented the moment you have even one subsidiary. So in that case, the separate financial statement plus the separate financial statement of the subsidiaries will be consolidated. The faculty who is taking Ind AS 110, 1111 and 112, there are three standards which they will be talking about. Those three standards will be helping you in consolidation of the financial statement. There will be a lot of worked out problems as well. Okay. In this particular situation, both for preparation of consolidated financial statement as well as standalone financial statement, you have to apply Ind AS 1 for the format and presentation of financial statement. In a general purpose financial statement, what is the purpose of financial statement? Basically, it's a theory question, but you know pretty well what is the purpose of a financial statement. The purpose of the financial statement is to provide information about the balance sheet. We call it as a financial position. Sorry. This is nothing but your balance sheet, right? Financial performance, how the entity has performed during the period, how it is determined by means of P&L. So information about the balance sheet, information about the performance, that's a profit or loss for the period, and what is the cash flows. This is the third one, right? So these are all the components of financial statement. Users should be able to understand and take an informed decision whether to invest in that company, whether to give loans to the company, whether to supply goods to the company, all these aspects, whether they have complied with the legal requirement. For understanding these purposes, you are providing information about the financial position. That's about the assets, liabilities, and shareholders' funds. Financial performance, whether it made profit or loss during the period. And the cash flows. What is the cash flows from operating activities, investing activities, and financial activities? How sound is the company's cash flows are? That is what the general purpose. Let us understand what is a complete set of financial statements. when we are talking about a financial statement, it contains various components, right? It contains balance sheet, it contains statement of profit and loss, it contains statement of cash flows, it contains something new. We will come to that. This is something new for India's scenario. Statement of changes in equity, we will come to that later. Notes comprising significant accounting policies, we are already familiar with that. Comparative, we prepare the financial statement 2020 March, so 2019 March will be a comparative for balance sheet as well as a P&L cash flow statement. This also we are familiar. We are familiar with this, 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 we are familiar with this also. And okay, this is another thing which we will discuss. What it says is that suppose if you are changing an accounting policy during the current period, you are supposed to give the balance sheet not only for the comparative period, but also opening period of the comparative. We will come to that little later because I talk about third balance sheet separately. There I will take it up. So this is something which we will discuss later. What is this statement of changes in equity? We have the schedule for share capital. We have a schedule for reserves and surplus under our existing format of financial statement. If I am combining both together, that is called statement of changes in equity. The statement of changes in equity will be given in two parts. Part A, equity share capital, where I will show what was the equity share capital on the opening date of the comparative period. For example, if you are talking about 2020 March. So if you are talking about 20 March, 31/3/2020, what is my comparative period? It is 31/3/2019. What is the opening date of the comparative period? This is 1/4/2018. So what I have to do is, when we are talking about the changes in equity, we say that A is equity share capital and B is other equity. We will come to this later. What is this other equity means? We will come to that little later. When we are saying this, what happens is the statement of changes in equity, starting with first part A, share capital, equity share capital. What is the equity share capital as on 1/4/2018? Add issues made during the year, less shares purchased back or bought back during the year, and then balance asset 31/3/2019. Then add shares issued during 2019-20, shares bought back during 2019-20. Then you will reach out what is the closing equity share capital as of 31st March 2020. What we are trying to do, we are capturing the movement right from the opening date of the comparative period till the closing date of the present reporting. So all these numbers will match with the balance sheet. So 2019 share capital will match with this number, 2020 will match with this particular number. Perfectly all right. So A is we have done. What about B? B says other equity means other than equity share capital, anything which is classified as equity should come as part of other equity. What could come as other equity? One of the item is general reserve. General reserve is also attributable to equity shareholders, but it is not share capital. So accordingly, general reserve as on 1/4 opening balance as on 1/4/2018 plus transfers from P&L account minus transfer to P&L account, closing balance as of 31/3/2019 and then 31/3/2020. So this is what you will give for general reserve. What could be another component of equity, other equity? Retained earnings, nothing but balance in profit and loss account. What is the balance as per 1/4/2018? What is the current year profit? And what is 2019 March closing balance? Maybe you might have paid a dividend distribution tax, all those items adjusted there, and you are arriving at 2019 number. Then what is the profit for 2020 is added, and then dividend distribution tax paid during the period is reduced. Any transfer to general reserve is also reduced. then closing balance is arrived at. So when we are giving this in a tabular column, we call that as a statement of changes in equity. What is the meaning of that? Balance sheet is a separate statement. Statement of profit and loss account is a separate statement. Statement of cash flows is a separate statement. Statement of changes in equity is a separate statement. Notes is a separate statement. So under old standard, we have four components. Four components we have, but under Ind AS we have 5 components. What is the fifth component? Is nothing but the statement of changes in equity. We will come back on the last one when I am taking the exact point of third balance sheet. Up to that we will keep this as a pending one. Now, one thing which I have seen is that the questions which you are posting is actually happening in a separate server, and that's vendor is working on that because the server is not connected. The vendor is working on that. We have escalated the issue to the vendor. So accordingly, whatever question which you are having will be downloaded and will be answered if we are able to download it today itself, and we will answer all the questions now. Suppose if I am not able to do that, what I will do is I will answer those questions and we will upload that answers also in the website, or maybe we will discuss tomorrow in the second session. So you have to bear with us because of the technical connectivity issue. But Board of Studies is parallelly working on that to restore that particular situation. Don't worry, all your questions will be answered relating to Ind AS 1, either today or in the second session. What is the general features of a financial statement? Going concern, that means the entity is going to continue at least for 12 months from the end of the reporting period, and it is not going to curtail its major operations within the next 12 months. So that is a going concern issue, matter. This we are already familiar. There is no difference on this. Accrual basis of accounting. All the incomes relating to the particular period should be accrued. Whatever expenditure for the particular period should be accounted on accrual basis. This also we are familiar. And materiality and aggregation. When you are putting some numbers on the face of the balance sheet or on the notes and accounts, whether every line item, for example, you have traveling expenses, foreign travel expenses, local travel and conveyance, whether I have to give all the three on the face of the financial statement or on the notes and accounts, can I aggregate them based on the concept of whether it is material number. So small numbers can be added so that the user will give a better presentation, right? So this materiality and aggregation is also part of our existing accounting standard as well as the existing Schedule 3, and accordingly this also we are familiar. Only thing which I will consider is there is a rule for aggregation. That is what should be minimum way in which rounded off number has to be presented. Whether I can put full number or I can put in crores, in lakhs, in millions, in thousands, in hundreds, whether I can do that. There is some condition which has come in. That alone we have to discuss. We will discuss separately. Offsetting. Offsetting is not specifically discussed in our existing accounting standard. What it says is that if I have assets, if I have liabilities, can I offset the assets and liabilities and show as a net figure? Let me take an example. I have trade receivable, I have trade payable. Can I net off these two figures and show as a net figure of trade receivable on the balance sheet? There are some conditions when we can do the offset. This is a new one. So I will discuss this separately as part of a separate slide. Consistency of presentation. The accounting policies which you are using should be consistently applied, right? When you are consistently applying a particular accounting policy, the format in which you are showing certain items last year, I wanted to see on the same basis in the current year also. So that is what we are talking about, consistency, and that consistency will also be one of the important requirement. Again, this is not new. This we are following it up even at our existing principle. So this is also not new. Then comparative information. Normally, we are supposed to give 1 year comparative in the balance sheet, in the profit and loss account, in the cash flow statement, in even the notes and accounts, right? Any running matter or any numbers which we are showing as part of the notes, we have 1 year comparative. So that 1 year comparative information, we are already familiar. What is only additional thing which we are adding is that this comparative information will also be applicable for SOC. What is SOC? Statement of changes in equity. We said that it's a new component, right? Because it's a new component, there also comparative is required. Other than that, this also we are familiar with that. Then, compliance with the Ind AS. Compliance with the Ind AS means if Ind AS is applicable to the entity, you have to comply with all the Ind AS applicable. So we are also saying no, accounting standards are complied in accordance with the requirement. So we will come to this. There is one specific discussion which we have to have, and that may be part of your examination question also, because there is something which has been peculiarly attributed to the compliance with the Ind AS. A specific requirement comes in. So this we will discuss additionally. Fair presentation. The financial statements has to be presented fairly. Here we are using fair presentation. Previously we used to call true and fair view, right? True and fair view and fair presentation are not different. They are same, and accordingly this also correct. So we have already discussed this. Left out is, new thing is compliance with Ind AS. You are saying something is new. Tell us what is that. I will explain. Offsetting, you said there are some rules for offsetting. Explain what is the rules. I will explain later on. Comparative information also required for SOC, because SOC is a new component of financial statement under Ind AS, right? So with that, the general features of financial statement has been considered. Now I am going to have one illustration. This illustration, I am going to open a file, Word file. This is coming out of somebody has asked this question now, how you will consider when it comes to the board of study, the institute study material. This is the institute study material illustration 1. Okay. So where they are talking about this Word file must be known to you, right? Are you able to see this, Shilpa? This presentation is visible, right? Okay, thank you. So, this particular item, what is the facts of the case? If you read this, this is already shared with you also, the illustration. If it is not shared, it will be shared along with your study material also, along with whatever presentation which I have made. It will also be shared. Don't worry about it. Here, what they are talking about is, this is entity XYZ is a large manufacturer of plastic products in the local market. It's a plastic product manufacturer, right? And what happens is that one second, I will just go to the technology. Okay, because the technology has to be used for underlying these things. So what happens? This plastic, it manufactures plastic products. Perfectly all right. On 1st April, we will assume that it's 2016. A newly elected government unexpectedly abolished all import tariffs, including 40% tariff for all imported plastic product. What will happen if the import tax has been reduced? Everybody will start importing material from other countries. Many other economic reforms implemented by the new government contributed to the value of the country's currency appreciating significantly against most other countries. The currency appreciation severely reduced the competitiveness of the entity's product. So, before 2060, entity XYZ was profitable. Before that, it was profitable. However, because it was unable to compete with the low-priced imports, because we have seen that import duties are cut, entity XY went into losses. As at 31st March 2017, entity XY's equity is 1,000. During the second quarter of March 2017, the management restructured the operation. The restructuring helped reducing losses in the third and quarters by 400 and 380. Losses is reduced. During the year ended 31st March 2017, XYZ incurred a loss of 4,000. What happens? Equity is only 1,000, loss is 4,000. So the net worth is totally eroded. There is a negative net worth of 3,000. In 2017, the local plastic industry, what has happened was, it's because of the change in import duty, competitive prices came in, low priced products reduced the profitability of the entity. They incurred a loss of 4,000 crore, whereas net worth is only 1,000 crore. To that extent, 3,000 crores of negative net worth is there. And in 2017 January, the local plastic industry and local union lobbied with the government to reinstate the tariff. Government incorporated in 2017 March that it will reintroduce limited tariffs at 10% in 2018. That means 2017 remaining to be the same, but there is some revision which will happen in 2018. However, it is emphasized that those tariffs would not be as protective as the tariffs enacted by the previous government. That means company may continue to have losses, but the level of losses may not be like 4,000. It may be coming down little bit. That's what they are trying to say. However, in its latest economic forecast, the government predicts a stable currency exchange rate in short term with a gradual weakening of the jurisdiction's currency in a long-term basis. That means there could be a possibility of appreciation will come down, depreciation will go up. So that means the foreign currency value will stabilize. Management has considered going concern assessment. Management has considered a going concern assessment for 31st March 2017. So, they are saying that it will result in a profitability. How should the management of entity disclose the information about going concern assessment in entities XYZ 2017 annual financial statement? From where we are coming to that, we are coming to only one aspect. Going concern is a fundamental concept for preparation and presentation of your financial statements. All these impact which you are seeing here shows that the company's net worth is eroded. Company is having a problem of regulated selling price in 2018 also. In that case, even though the company makes an assessment that they will make a profit or turnaround in 2018, with the regulated environment, what type of disclosure has to be included? The first thing is that whether the entity is eligible to prepare as per going concern assessment is the first question which we have to see. The second question is, even if they are eligible to prepare for 2017 March or 2018 March, what is the supporting evidence which they are having is the next question which we have to see, right? So if we are looking into that particular aspect, what we can see is that it's a general feature, right? We have said that it's a general feature. Whenever we are talking about, it's a general feature. So it is a basic principle. And accordingly, entity shall prepare only based on going concern unless two aspects, right? Intends to liquidate the entity, or it is no realistic alternative to do so. Meaning what? I wanted to continue the business. Perfectly the company also says. But do you have a realistic alternative without ceasing the trading activity? For example, if you are able to continue not to deal with the plastic, you convert into something else. For example, some of the plastic industry, when that ban has happened, changed to a particular product which will be acceptable as per the pollution control norms. They have switched over. is there any realistic alternative which is available? So you look into that particular aspects, and based on which you can prepare accordingly. But still, there are lot of uncertainty, right? It may cast a significant doubt whether the entity is continue as a going concern. So accordingly, all these factors has to be discussed. People normally say that now 12 months is the period, end of the period. That alone you have to see. But with this severe uncertainty which they are having, you have to make a detailed disclosure. In your study material, it has given a suggested disclosure. That is what I have reproduced here. Whatever information for the users to understand, they have reintroduced a limited period of import tariffs has been changed, but that tariff is not as productive as 40% of the existing tariff. What it also says that during the year, 10% the company will remaining to be profitable, and the net worth is only 1,000 crore. And if the remaining is not unchanged, impost duties and other is not unchanged, the company could not exceed, the liabilities could not exceed according to the 2018 assessment. On that basis, the entity has believed that it can prepare under going concern. So all the uncertainty relating to going concern should be first discussed with factual information. On that basis, how the entity has considered that it can still prepare as per going concern is the first question which we have to answer. So this is one of the illustration which I thought that I will share. Now, there is an offsetting principle which we are saying. I said I will come back and talk about that. We will take this question for you to understand this. What the standard says is that if you see, it says that you should have a legal right to offset, and it should represent net presentation is appropriate for the user to understand the transaction. So these are two things which we are supposed to have. So when I am talking about, for example, trade receivable and trade payable, can I offset that and show as a net figure? Trade receivable is receivable from somebody else, payable is to somebody else. How I can have the legal right to offset? And is it net presentation a correct presentation? It's an incorrect presentation because it is two different type of activity. It will only distract the ability of the user to understand the financial statement. So gross presentation has to be given. Net presentation is not permitted in that particular situation. Here we are taking another illustration. If offsetting of revenue against expenses is permissible, in case of a company acting as an agent and have sub-agents where the commission is paid to sub-agents from the commission received as an agent. So much of agents are coming in, don't worry. The simple concept is A Limited follows Ind AS. It is an agent of B Limited. That means I'm not, A Limited is not manufacturing anything. It is only acting as an agent for B Limited. When it is eligible for commission, say at 10% on the sales which has been made, 10% commission on sales. So for everything which has been made by A Limited in respect of B Limited. So agreement is B Limited is principal, B Limited is principal, and A Limited is an agent. So when we are recognizing the revenue in A Limited, this is the question which we are having. In A Limited, can I record all the sales which I have made on behalf of the principal as my revenue from operation? That's a gross presentation. No, it is not the cash flows attributable to me. It is a cash flow attributable to my principal. I am only acting as an agent. I am entitled for only 10%. So the 10% is my gross income, right? This gross income should be presented in my P&L as per Schedule 3, right? Sorry, My handwriting is working with a stylus pen. Because of that, it was a little poor. And maybe I can also use a little casually. Then it will be visible. But I'm explaining that you please take note of it. So the 10% of the commission is actually the gross income for A Limited, which should be shown in the P&L account as per Schedule 3. The question says that suppose if B Limited is also having two agents, sub-agents. Sub-agents are appointed by A Limited, say for example C and D. And for them, it pays 5% of sales. In other words, it takes 10% from B Limited, and whatever sales which has been affected by C and D, it shares that 5% commission. So that commission is, in other words, the net commission which he earns is only 5%, right? So the question here is, you have said that as far as the revenue from operations by A Limited is concerned, you should not take the entire sales. You have to only take your sales figure. Now, out of this, you have to take only the commission figure on sales. So you have said that 10% only has to be taken. And on this 10%, you are also sharing 5% to others. In that case, whether that 5% should be netted off against the income. So gross income should be whether 10% or 5% is the question. Okay? Because I have a sub-agent. In this case, please understand, if I am recording only 5%, even though I am getting 10% from my principal, this is a expenditure being offset, and the user of the financial statement will actually not able to understand what is the revenue from operation of A Limited. So accordingly, this 5% is a selling cost for A Limited. So that should be shown as an expenditure. That should be shown as an expenditure and should not be offset. It should not be offset against the commission earned. In the P&L, income from operations, I will show 10% whatever I am receiving from B Limited as my revenue from operation. Below that, I have to explain major heads, commission income. In the expenditure side, I will show what is the commission expenses which I have incurred. So it is not net off or offset which will be permitted to be done for a simple reason. That is the expectation which is coming out of that. Okay. Then we have another illustration which is required. What it says is that one company has acquired another company, and they have accounted a provisional basis the annual financial statement in the year 2011. Just assuming 2011 or 2021, you can say. The business combination was finalized in the next year, and the provisional fair values are updated. As a result, comparatives were adjusted in the next year. So, whether you are required to give on the first day of April 2020 also. So, I told you, when you are giving a comparative, you will give comparative for the previous year. And when there is a change in accounting policy retrospectively, you will also prepare for the opening date. That is 2020 March means I will also give for the opening date. That's a comparative. I said we will discuss later. I think that this question can be taken along with another detailed presentation which I am having. At the time I will come back, because now you will get confused with the third balance sheet. I will take this at that point of time. We will come back on this particular question. Now, I am going to share the PPT again. So we have seen the illustrations also. In case if there is a departure from the requirement of an NDS, is it? Sorry? Presentation coming or not? Not coming. One second.
Sir,
I will share. Yeah.
sir, query link is now working.
Working. Okay. I will then take it up. I will take it up.
And we have sent you an Excel sheet also.
Yeah, I will do that. So now it is visible, PPT? Okay. I will load the question link and then we will work on that. Okay. I will first answer those questions and then I will come back on this PPT because it will help you to have the answers quickly for all your presentation. Lavanya has asked the first question. Schedule 3 does not permit companies to avail the option of presenting assets and liabilities in the order of liquidity as provided in Ind AS 1. Since Ind AS 1 permits a different disclosure than the format given in Schedule 3, will the requirement of Schedule 3 be considered modified according to Ind AS? This is what I have explained. In case if there is a Schedule 3 is notified as per the Companies Act 2013 and it has prescribed a format, law prevails over the standard and accordingly in Schedule 3 we have permitted only the presentation of current and non-current classification, and only for NBFCs the liquidity order of presentation has been given, and to that extent you will actually have that particular discussion in full. Only you will use the current and non-current classification as far as non-NBFC companies are concerned. Okay, that we have answered. The second question is there is a different treatment of security deposit received by electricity company and gas company. Honey Jane, hold on this particular question. When I am talking about current and non-current classification, I will talk about this unconditional right to defer settlement, etc. because everybody will be on top of it. So I will explain that. I will take up this particular question at that point of time. What was the last time Ind AS 1 is amended for the purpose of exams? Don't worry, Vivek, the amendment is not yet made, any changes is not yet made, and accordingly whatever you are having as the Ind AS 1, you can actually take it straight away. So whatever I am teaching now is what you are going to use it for your examination point of view. Then we have what is the roadmap? We have already discussed. Discounting rate we have done. Is there any amendment for November 2020? Nothing is the amendment which you have to worry about it. Short line about IAS and IFRS and Ind AS, we have already discussed that as part of the overview. And we have, can you please attend to the question of students at the end of the session? So I will do that. Don't worry about it. When I am talking about attending these questions, Aman, I will suggest you one thing. If it is relevant during the particular situation, taking that will not disturb that. Otherwise, people will have some doubt on whether we are really explaining the concept or not. Then we have talked about, one second, I will download this because every time it goes up whenever the new question is coming in. Maybe I will download the question that will help me out in doing it in a simple manner. And also, even if the connection is disconnected, I can actually answer all the questions. Okay. So now I'm fair to go on that. Okay. Can this one of the question which is coming in is, do we need to study all accounting standards applicable for non-corporate entities? My understanding is final syllabus is full and full Ind AS, and to that extent, your financial reporting will be only on Ind AS basis. And to that extent, the other accounting standards which you have already read in IPCC, there is no need for you to look into that particular standards at this point of time. Do we need to mention IAS and IFRS name and number along with Ind AS in examination? Definitely not required, because the Board of Studies as well as the Accounting Standard Board is only talking about Ind AS only for you to understand the hierarchy in which, or the history by which we have derived Ind AS. I was referring to the standard. So if you are knowing the Ind AS standard numbers, you write it. But if you are having a doubt whether to write that particular Ind AS number is correct or not, preferably don't talk about that particular number, because sometimes the examiner may have a different feeling that you are not understood and you are quoting a wrong number. Preferably you can try to memorize this number. It's very easy, nothing to worry about it. You can do that, because hardly we have to talk about them 30-40. If you are not able to do it, nothing to worry. But there is no need to mention the IAS standard or IFRS standard, as the case may be. Then whether this is up, okay, old syllabus. So slide again. What is it? So what is the threshold limit for companies for applicability of Ind AS? We have already discussed. There are three threshold limit. One is net worth criteria, listing criteria, unlisted criteria, and the subsidiary criterion. We have said that it will be based on whether you are a group company or a non-group company of a company preparing under Ind AS. So we have already discussed that. And study material, we have already discussed everything we are going to discuss. What is roadmap? We have already discussed the roadmap for general companies, roadmap for NBFC companies. We have also said that the roadmap for banking companies have been completely deferred. For insurance companies, accounting period commencing on or after 1st April 2021 has been announced. That also we have discussed in 3-4 slides. Question, you mentioned about Ind AS 17, is it removed? Yes, Ind AS 17 is now removed. That's what I have explained, that hereafter Ind AS 116 will be applicable relating to all leases. When you are talking about Ind AS 116, there will be a separate session. There is a possibility of short-term lease exemption which you can take. In that case, you can apply the principles of escalation on a straight line basis only if it is more than the inflation index. That is a mandatory carve out. Yes, Ind AS 116 we have already discussed, 17 and 116. IFRS 17 and Ind AS 17 are different. IFRS 17 is going to be for insurance contract. Ind AS 17 is for the purposes of leases. That is now eliminated. Only Ind AS 116 will be there. When insurance is being brought in, it will be Ind AS 117. What are all the requirements for the SLM in lease as per Ind AS 17? Please wait for your session on Ind AS 116. You will be having a detailed one. And IFRS is okay. Okay. Then is it applicable to whole syllabus also? Okay. So both standards are okay. Then slides. Difference between IFRS and Ind AS, the carve in and carve out. Somebody is saying that the slide is not visible. Maybe the connectivity issue may be there for you, for Minu. What my suggestion is, once the slides are uploaded, you can download and see that. In case if you are having still any questions, please talk to me. And then recordings anyway will be uploaded, I think, by the institute. Again, you are talking about lease accounting, that will be kept separately. please make notes of the examples and other things which I am giving, explanatory statement which I am giving. Whatever you are seeing on the screen will be shared to you. Additional explanations which I am giving, please take note of it. Government rate, again discounting rate. Roadmap we have already explained. No amendment which I have already told you. So please give summary of shortline about IFRS we have already discussed. All the questions and Sitala, the reason why I am taking that part of it is, if I am just going to take all the questions at a later point of time, there is a problem, because that will be an issue of not understanding the concept. That's the reason why we are talking about. This list of carve in and carve out is an exhaustive list or inclusive list. It is an exhaustive list. So we are having only limited items amend. So whatever I have shown on the screen are the actual carve outs. So you can simply take them as a carve out. Others are not considered as a carve out. When we are seeing another slide, you will see that, for example, we are using the word balance sheet, whereas IASB is using the word statement of financial position. So that type of changes are not considered as a carve out. Similarly, IAS gives two options, but we have deleted one option. And we said that only one option is available. No alternative option is available. That deletion is not considered as a carve out. So accordingly, whatever I have shown is part of that thing. Okay. Examples of carve out I have already explained in detail. OCI and comprehensive income, what is the difference? I will take it a little later. India is applicable to all companies in India, we have already discussed. Exhaustive list of carve out, yes, we have already discussed. Is IAS still applicable? Because IAS is still applicable, as I have already told Shivani, that IAS series standards are still retained. IAS 1 is equivalent to our Ind AS 1. So they are still there. They are only using IFRS as a compound statement to cover IAS series standard as well as IFRS series standards. Both are still there, but nothing to worry on for your examination. Is there any limit for paid up capital and reserves and surplus? We have already discussed. Net worth is greater than or equal to, just greater than. It is equal to or greater than. That is what it is used. 500 crore or more, 250 crore or more is what is used. In examination, please be careful when you are writing that. If you are saying more than 500 crore, you may not get the full mark. But I have never seen exactly 500 crore net worth or exactly 250 crore net worth. But law says it's 500 crore or more, 250 crore or more. US GAAP, IFRS, Indian GAAP, AS, Ind AS, it's a separate session, Aniruddha. US GAAP is not part of our discussion. Accordingly, NBFC we have already discussed. Suppose a subsidiary of the NBFC is unlisted company, then it will be based on the net worth. Yes, that is what we are supposed to say. But if the parent company is already under Ind AS, irrespective of the net worth, the subsidiary should also be considered, even if it is unlisted company. That is a Shravani's question. Net worth, okay. Does Ind AS need to be applied for all years once it comes under net worth criteria? Yes, that's what we have seen, Ramya. If you have started applying Ind AS, you cannot go back. It has to be continuously under Ind AS. If a company not covered under Ind AS, with respect to presentation of Companies Act shall be followed. That's what I have said. You have to follow Schedule 3, Division 1, in case if it is not applicable to them. That is coming from Tomala. Suppose A Limited is in UK, which is a holding company of B Limited, India, then Ind AS will be applicable to A Limited also. Interesting question. I think I should thank for this particular question for a simple reason. In case if we are talking about Ind AS roadmap, we are talking about companies registered in India. Accordingly, if in your question, if the holding company of B Limited is an UK company, they are not covered by Indian Companies Act. So Indian Companies Act section 133 applicable for the presentation of financial statement as per Ind AS. So UK company will not get covered by that. They will prepare as per UK GAAP. So accordingly, Ind AS is not applicable if the parent is a foreign company. But for the A Limited, which is Indian company, and that company in the standalone basis, we have to see whether net worth criteria applicable or listing criteria is applicable or not. And then associate company and joint venture company, Srinivas, the same thing which I have discussed, that whatever is applicable to subsidiary company, same thing is applicable to holding company, associate company and joint venture company. So that should also be considered based on whether the parent company is considering that. What is the difference, by the way, listed companies between listed company and proposed listed companies? Listed companies is already registered in the stock exchanges. Proposed listed companies not yet completed the public issue. They have started the process and made known to the public that this is what they are going to do. If a company is a partner of a partnership firm, will the partnership firm is eligible for Ind AS accounting? Good question, Sumit, but I wanted to tell you is that Ind AS is made applicable based on section 133 of the Companies Act. Accordingly, partnership is not a company and partnership is not required to prepare under Ind AS. What if any NBFC, banking, insurance companies joint venture? We have already answered that question. And sir, if you mentioned listed companies has to follow it mandatory, then why, sir, net worth, and if not proposed to be listed, but the net worth is less than the threshold limit, then what is the impact? Chidambaram, your question is well understood by me. Why listed companies, irrespective of the net worth, is covered, even if they are having a negative net worth? Simple logic. They are dealing with the public money, and accordingly, the accountability and the responsibility should be much higher than an unlisted company. That is the reason why, without even net worth criteria, listed companies have been brought into the requirement. Why the company not covered in phase 1 even after net worth of 500 crore or more? So I am not able to understand, Akash. I think that you are talking about a company which is not covered based on net worth of 500 crore or more is not covered in phase 1. Sorry, if it is covered more than 500 crore or more, it's covered in phase 1. If it is not covered, then it comes to phase 2, then we will do. Another Dheeraj is asking another question from New Delhi. Can't the voluntary application from 1st April 2000 be considered as phase 1? Dheeraj, thank you for reminding me this particular thing. One point which we have not discussed is phase 1, phase 2, etc. we have discussed. But if a company voluntarily to comply, even I am not having net worth of 250 crore, net worth of, I'm not a listed company, I'm not an proposed listed company, but I wanted to apply Ind AS. Can I do it? It is allowed from 1st of 2015. So any year you can voluntarily adopt. If you are adopting, it will also be part 1. But voluntary adoption, I don't want it to mention as phase 1. It is a discretion of the company. But rightly pointed out by Dheeraj, any company can voluntarily adopt for a particular period, not necessarily 2015. 2020 also they can voluntarily adopt. So from that year they will follow Ind AS. Should a private company in phase 1 follow Ind AS if its net worth is 5 crore? Sir, 5 crore net worth, Lavanya, you need not even worry about it, because net worth criteria for unlisted company, when I am using the word unlisted company, we are covering public unlisted company, private unlisted company. Both are covered as unlisted company. Accordingly, the net worth should be minimum of 250 crore. Otherwise, it is not applicable for a private limited company. It means the net worth is above 500 crore, then Ind AS is applicable immediately from 1st April 2017. Vijay Pradap, your question, I understand, is that suppose if the net worth as on 31/3/2014, it is applicable for accounting period commencing on or after 1st April 2017. As on 31/3/2014, net worth is less than 500 crore. Subsequently, it has crossed to 500 crore, assuming that it's also less than 250 crore as on 31/3/2014. Because if it is more than 250 crore, it might be applying Ind AS automatically in the phase 2. So To answer your question, I am assuming that as on 31/3/2014, your net worth is less than 250 crore, and subsequently it has crossed 250 crore. The moment you have crossed 250 crore, the next immediate year will be the date of applicability for Ind AS for you. So that is the reason why I gave an example where the net worth has crossed in 20 March. So 20 March you will not apply Ind AS, but 21 March you will apply Ind AS. Immediate next year. Reason is 2014 you are not having a net worth of 250 crore or more. Subsequently you have reached that, crossed the threshold limit. Immediate next year will be applicable. That's what I have explained. So in 17, it's based on 31/3/2014 net worth. Okay. Ashna's question from Calcutta I have already answered. If immediate next year where you are crossing 500 crore net worth, you will get covered. Not necessarily 500 crore net worth. Even if you cross 250 crore net worth, you will get covered. How to calculate net worth, I have already told you. Net worth is nothing but as defined by the Companies Act, minus the revaluation reserve, minus the write back of depreciation, minus the amalgamation reserve. After that, you get that net worth. We can say today unlisted companies net worth greater than 250 crore, listed companies, proposed listed companies are required to follow. Pace manner is over. Rahul, you are on the dot. Exactly this is what I have summarized. If an unlisted company is greater than 250 crore, automatically covered. Listed company, automatically covered. Proposed listed company, automatically covered. The paced manner is already over for general companies and non-banking finance companies. You are on the dot. For banking companies and insurance companies, we have to wait and watch, right? What is the roadmap? Priya Jain, if net worth is 250 crore or less, the earlier year accounting standard will be followed for unlisted companies. Yes, that's what I have said. Companies Accounting Standard Rules 2006 as amended from time to time should be followed. Supreet Kapoor, if any company apply Ind AS willingly, that's a voluntary adoption. So when you are using the voluntary adoption during the year, comparative should be as per Ind AS, and you have to prepare your opening balance also as per Ind AS. So the same rule applicable. After applying Ind AS, company's net worth is reduced than the threshold limit, then it is necessary to follow Ind AS. Yes, Surya, that's what I have said. It is a one-way traffic. The moment you have entered into Ind AS and started presenting as per Ind AS, you can never come back. You cannot follow other accounting standard, even if your net worth come down below the threshold limit, even if you have delisted your shares from the stock exchange, you cannot avoid following Ind AS. It's a one-way traffic. You have to continue to follow it. Srijuna is asking, what if the company is listed earlier, adopted Ind AS, later the company was delisted? I have already answered. Are not we using Ind AS 116 leases now? Yes, we are using it. That's the reason why I said, please wait for the particular session and learn further. Ind AS 17 is now repealed. Ekta Jain is asking, was there any such provision like net worth of only preceding financial year has to be covered? Or any of the last 3 years? No, it is not based on any last 3 years. The moment you have crossed the net worth, immediate next year is applicability. Don't talk about average 3 years net worth, etc. That is not applicable, Ekta. In case if you have wrongly understood, please correct yourself. Is it net worth in the previous financial year or current financial year? Net worth in the previous financial year, because you will cross that limit, then only I will know that you have crossed it. Okay. So if I'm trying to identify whether 2020 I have to follow Ind AS or not, I have to see what is the net worth in 2019 March. If I wanted to apply 2021, I have to see what is the net worth on 20 March. So accordingly, it is a net worth of the previous year and not current financial year. Migir Soni, what is write back of depreciation? Migir Soni, this has happened when Companies Act 2013 has been introduced. Schedule 2 has been introduced for depreciation. Please read the Schedule 2 requirement. It will be part of your Companies Act 2013 company law, as well as when you are reading Ind AS 16 property, plant and equipment, how the depreciation should be charged. At the time you will have the answer. When Schedule 2 has been implemented, some companies who are using a different depreciation principle has to write back the depreciation. So that is what's sitting in the retained earnings. To that extent, the net worth has to be reduced by that particular number. Suppose NBFC is a subsidiary of a company already covered. We have already answered this question. If Ind AS is applicable from 1/4/2016 or 1/4/2017, when we have to calculate the net worth of yes, if it is applicable from 16 and 17, you will calculate based on 2014 March, Yogesh. Suppose after 2014 March your net worth has changed, then you will see the applicability for the immediate next year. Again, Surjana is asking, for calculating net worth, can we include SEZ and debenture redemption reserve? You will only 3 items have been excluded, so automatically that will also be part of your net worth. So revaluation reserve is exempted, amalgamation reserve is exempted, depreciation return back is exempted. These are only 3 items which has to be excluded. So any other reserves will be automatically included. Will the classes be taught from institute modules itself, and will separate notes to be provided for? It is from the institute module only, Saloni, for your information. Is Ind AS applicable to holding company when the subsidiary only meet the Ind AS criteria? Yes. Ajit Das, as you have rightly observed, if the subsidiary has met the Ind AS recognition criteria, but the parent company has not met Ind AS recognition criteria, if you see the supplemental criteria which I have said, holding company also should follow. If the subsidiary follows Ind AS, holding company should follow Ind AS. Not necessarily only subsidiary, associate and joint venture. Holding company should also follow. If the holding company's cross threshold limit in 2019, when should be applied? 2020 you have to apply. We have already discussed about that, Pusa. Okay, thank you for your appreciation, Sandeep. Effective teaching. SME stock exchange, there is a stock exchange where you can go without like BSE and National Stock Exchange, where the limit of the amount which you can list there was very reduced. So small companies can also go to SME stock exchanges. If you have listed only in SME stock exchange, you are not considered as a listed company, and to that extent you are not covered by Ind AS unless net worth is more than 250 crore. Chandan Kumar explained the meaning of SME stock exchange. Now I have explained that. If Ind AS is applicable for a company in phase 2, then still net worth is calculated. Yeah, because to decide whether it's phase 1 or phase 2, Jatin, for the first time you are taking from 2014 March. After it has crossed the 2 phases, no, then we will calculate what is the net worth of the previous year. Next year we will apply. Amandeep is asking, listed companies in SME, when it exceeds 500 crore, then it has to be follow Ind AS. If below, it will not. You are perfectly correct, Amandeep. When I am talking about listing requirement, listed in SME stock exchange is exempted. But net worth criteria is not excluding listing in SME stock exchange. In a standalone financial statement, if the net worth is more than, it is 250 crore or more for an entity which is listed in SME stock exchange, based on the net worth criteria, it will follow Ind AS. So you have to always see 3 different criteria has been given. Any one criteria met, you have to automatically get covered. So you have covered by net worth criteria, you have to automatically follow. Second criteria is listing. There is an exemption available, so you are not entitled for it. What did you say for banking company? If a group company or listed company, not very clear, it will have to follow Ind AS. No. What happens is, if banking company is a group company, since the adoption of Ind AS has been deferred, they will not follow Ind AS. They will prepare as per the existing accounting standard. For consolidation purposes, the line items will be grouped according to the parent company's Ind AS format. Whether the banking and insurance company, which is a holding subsidiary of a main company following Ind AS, meets the threshold limit of 250 crore. No, even if they are meeting the threshold limit of 250 crore or more, based on the net worth also, banking companies and insurance companies are not supposed to follow, because early adoption is not permitted for them. If companies not meeting threshold limit can follow this, Surya Kiran is asking this question. Only a bank, it can follow on a voluntary basis. Not meeting any of the threshold limit, a company can follow. The exception is banking companies are not permitted. insurance companies are not permitted. Before the roadmap for NBFC has been introduced, they are also not permitted. Since the roadmap for NBFC is already applicable, so any NBFC can now follow from 2021 onwards, not from 2020. It will not follow that particular scenario. So NBFC cannot follow, banking company cannot follow, and insurance company cannot follow on a voluntary basis, even if in case if the threshold limits are not met. Other companies can follow. Suppose XYZ for 2021 banking company X Limited subsidiary Ind AS is applicable to Y Limited. X Limited is a general company, Y Limited is banking company. No, Y Limited is not applicable because the roadmap for banking company is not yet made applicable. Is there any companies which follow both IFRS and IAS? Rubini, I appreciate your requirement. None of the companies are following Ind AS for the purposes of in India. They are following in foreign countries, wherever IFRS is the reporting requirement. For example, if you go to Middle East, entire Middle East, IFRS is the only standard. IFRS includes IAS series standards and IFRS series standards. Both put together is what we are calling as an IFRS. So they are following that. In India, it's Ind AS is only applicable. And okay. After 31st March net worth criteria, I have already explained. Is there any specified period up to which Ind AS is required to comply once it applicable to no specific period? Once you have entered, it's a one-way traffic. You have to continue to use only that. PPT for yes, it will be given. Not getting the link for general roadmap for listed and proposed listing with the criteria of Ind AS applicability. So it is already I have explained. If parent company is banking company and subsidiary is meeting net worth requirement, please clarify once again. So banking company as such not applicable to follow Ind AS. Subsidiary company of a banking company not eligible to follow Ind AS. But the subsidiary is a general company. On a standalone basis, it meets the recognition criteria. It is a net worth is more than it's 250 crore or more. It has to follow. So based on its independent or individual criteria, meeting the criteria, it has to follow. If it is only a group company of a banking company, but not meeting any of the criteria of net worth or listing or proposed listing, it need not follow. NBFC and its holding company, we have already discussed. What is the net worth over the limit in between? That is, we have already discussed. The holding company is an insurance company, we have already discussed. Thank you, Magesh Babu, for giving your appreciation. This is the passion with which I normally come to discuss, because I have been accused by the students that I normally make a presentation only to members. Why not your knowledge be given to the students who are now supposed to attend only on Ind AS? So that is the reason why I have come down a little bit to share my knowledge. Slides, if it is written applicable, okay, first, but you are telling applicable from March 22. That is Anirban, I will explain the concept. Accounting period commencing on or after 1st April. So that means 1st April to year end, up to year end we will do now. So 1st April 2021 means year end is March 2022. That's the reason why I am saying for the year ending 31st March 2022, your starting date is April 2021. In slide, I am using exact word which is coming from the roadmap. Roadmap only starts about what is applicable for the accounting period commencing on or after. So in your examination, please write accounting period commencing on or after 1st April 2021 means what is the applicability. Amandeep, I am confused with the SME stock exchange. Now you might be very clear on that because I have already explained. On 31st March, standalone net worth is less than 250 crore, but net worth of group is more than 250 crore. Jatin, this is good point which I have to explain. What Jatin is saying that if the net worth asset, whatever date which we are assessing, standalone basis net worth is less than 250 crore. But I have prepared a consolidated financial statement that is more than 250 crore or more, or sorry, it is 250 crore or more, right? So whether I have to use a consolidated net worth or standalone net worth, thank you for reminding me this particular point, Jatin. Only the standalone net worth has to be considered. You should not consider the consolidated net worth. Okay. So in your examination, you are saying consolidated net worth of the group is 250 crore or more, not is the basis. Only the standalone should be seen. In standalone, in your example is less than 250 crore, and accordingly that is not required. And banking insurance company, we have already discussed that. Vikram, main difference between IAS and IFRS, it's not part of your syllabus. And then list of carve in and carve out, it's already there in the presentation, Prajal, you can use it. Holding company outside India, I have already explained. Ragini is asking, as per amended guideline, India is not applicable to insurance company, right? So this insurance company is from 1st April 2021. That's what I have mentioned as of now, Ragini Gupta. What if the company proposed to get listed in March 2020 and get listed in April 2020? Pankaj, this is interesting point. Suppose it has already passed the resolution and started the process of proposed listing in before March 2020. India is applicable for year ending March 2020. It is not postponed. It is not based on the date of listing. That's the reason why I said 3 criteria. One is net worth. Another is listed. That means listed as on a particular date. Proposed listing, going to be listed. So even if it is going to be listed in March 2020, immediate applicability will be March 2020. In fact, I worked on one of the client where they have passed a board resolution and appointed the registrars for the issues and the merchant bankers in February 2020, and their financial statements have been prepared as per Ind AS for March 2020. Because the next year applicability is applicable only for net worth criteria. Okay, proposed listed we have already discussed. Will the notes of lectures will be provided? Please note down the examples which I am providing with it, because out of my experience, I have lot of examples which is practical. So you note down those notes, because whatever you are getting will not have a detailed one what I am talking, because I am not memorizing the entire thing and giving it to you. I am sharing my experiences, sharing out of my practical conversion to companies. So you have to note down. Maybe after the PPT has been shared in that particular area itself, you can note down what is the way in which you can recap when you are doing a revision. That okay, Kishore Kumar, old syllabus. Startup company whose sales is lower than 10 lakhs, but they have spent around 20 crore in their branding. So it is not part of Ind AS 1, so I will not talk about that. Ind AS 38 is talking about intangible assets. They will talk about that. In case banking and insurance company, we have already discussed how companies will follow Ind AS after that meet subsequent to 31st March 2014. We have already discussed. Listing criteria we have already discussed. Are there companies still following old accounting standard? If their net worth is less than 250 crore, they have to necessarily follow that. Format of financial statement will be discussed. Yes, that is what I started with schedule 3. We will discuss that in the next session. Holding company, normal company, subsidiary company, NBFC. We already discussed that example. Can you please explain how will company follow after that? We have already discussed. Example of A3 subsidiary companies has net worth of 550 crore, but as on 28, we have already discussed this example also. Conflict between Schedule 3 and Ind AS 7, Amandeep, we have already discussed that particular point. Okay, whether electricity companies will follow Ind AS or not, they haven't exempted from following Ind AS. Only the format has been given to them. Will be provided recording. Okay. Statement of changes in equity. Don't worry, we will discuss statement of changes in equity as part of Schedule 3. Okay. Don't worry, Monica. Viewing my face and the slides, there is some problem maybe in the connectivity. It will get connected. Okay. Any other question which I have not answered? Preparation of financial statement is as per applicable financial reporting framework. That's what I have mentioned. If it is Ind AS is applicable, that is a financial reporting framework. If India's threshold limit is not met, Companies Accounting Standard Rules 2006 will be the framework. Take study material examination examples. I have already started, and we are going to have another 15 study material examples, and we will discuss in the second session. Don't worry about it. So I have answered all the questions which came in this. Illustrations, please note down, because don't expect me that I have to give everything on a platter, because what I am giving is only a question. The exam answers which I am giving, go back to the study material and read it. You will have that. In case if you wanted to note down, you note down, because I don't want to give everything as a platter. Little bit of going back and reading will help you to revise your sessions. So with that, we are coming back to our session. So since the session is up to 10 o'clock only, I will stop the session as of now, and we will continue the balance portion as part of our discussion on July 3rd between 7 to 10. And don't worry, I will do all the illustration in the study material. My suggestion is you can also make a quick study of your study material, so that when I am answering, you can be able to understand what we are exactly answering. With that, I am closing the session. Shilpa, anything which you wanted to add now?
No, sir. Thank you. For certain queries which are related to BOS and not to the technical session, we'll reply to the students individually. We are having their mail IDs. We'll reply to them individually.
Sure, sure. With that, you can close the session for all, Shilpa.
Okay. Thank you, students. Hope you have gained a good knowledge from this session, and you'll be using this knowledge for optimizing your studies. And thank you, sir. Thanks a lot for your valuable guidance and your sharing of experience, and looking forward for the coming session. Thank you, sir.
Sure. Thank you, Shilpa, for the seamless coordination and also helping me out on the technical side. Thank you so much. My thanks is also to the IT team, which is actually providing a very good service. Thank you.
Bye, sir. Bye, students.
Bye.